Very good morning, friends. I hope you're all doing well. So, we were doing consolidation, and within consolidation, we have covered up Ind AS 103. I would call it as a part of the consolidation, though it's a business combination standard. Ind AS 110, we are now working on Ind AS 111. And we are here to cover up Ind AS 28 as well, and a bit of overview on Ind AS 27 as well. So let's come back to what we were discussing in terms of Ind AS 111. I've already given you some insights on Ind AS 111. Just to remind you, I divided the standard into a total of 3 blocks. I'll just take a quick recap and then take the inputs further. We are working on the block number 2. So to remind you, just a quick recap in terms of a small mind mapping. We decided that when we're looking at Ind AS 111, the name of the standard is called Joint Arrangements. I like to put it as JA. And I said, in order to understand this particular standard, you can divide the standard in terms of 3 blocks. That's how we can easily understand this standard. So we decided that there are a total of 3 blocks as far as the standard is concerned. The block number 1, or you can say the step number 1, whatever you prefer, is deciding that is the arrangement. It is deciding that is the arrangement a joint arrangement. So you need to decide that is the arrangement supposed to be a joint arrangement. And I give you a 3-step model in terms of deciding when an arrangement is a joint arrangement. So we decided if you want to decide that it is a joint arrangement, we have got a total of 3 steps to be applied in a sequence. The step number 1 to decide whether it's a joint arrangement is to decide that it is supposed to be a contractual arrangement, that is CA. Wherein we said that there should be an agreement between 2 or more than 2 parties so that you define all the rights and obligations of the parties in the arrangement. And generally, they will have a written agreement, but even an oral agreement could suffice. But they just need to be very clear on the rights and obligations of the parties to the arrangement. And then we said, in terms of step number 2 as well as step number 3, if I put the step number 2 and 3 put together, we can say we are basically looking at the evaluation of a joint control. So we're basically looking at the evaluation of a joint control. Let's call it as JC. The step 2 and 3 put together is supposed to be an assessment of a joint control. Now, when you say a joint control, the step number 2 and the step number 3, you need to evaluate that there is a CC, collective control, and there is a UC, that is a unanimous consent. So once you are able to prove a collective control and a unanimous consent, it becomes a joint control. And we said there are questions to be put across in terms of CC as well as UC. There are 2 things to be seen in a joint control. I cannot take decisions alone. That means I am a part of the collective control. And the other persons also cannot take decisions without me. That means I should be in a position to block their decision. So when I'm going to look at a collective control, my focus would be that can I take decisions alone or not? And when I'm looking at unanimous consent, can I block other people's decision? If both the factors are there, you get a joint control, otherwise not. And just to remind you, I also gave you the inputs that when you're looking at a joint control, the joint control could arise out of, the joint control could arise either on account of voting rights or on account of representation on the board of director. So you need to be careful when you're evaluating the concept of a joint control. I give you charts in terms of 2 parties as well as 3 parties. When you say there is a joint control, we decided that if there are 2 parties with an equal percentage, it's implied JC. irrespective whatever combination, whether you need a majority or a certain percentage, it is an implied joint control. But if there are three parties also, then there could be a possibility of a joint control between, let's say, two parties or maybe all three. That depends upon the percentage. And if the decisions are taken on the basis of board of directors, depends upon how many directors can each party appoint, with the concept of a casting of vote of a chairman and all those things we saw. Then I also said that you also need to keep into account the concept of relevant activities as well. And when you look at the concept of relevant activities, different parties may be responsible in terms of managing different activities. So we need to find out that which is the most significant of the relevant activities, who is going to be responsible in terms of taking decisions which are most significant in nature. So when you get the relevant activities, you need to identify which is the most significant relevant activities. And relevant activities has got the same concept what you've done in Ind AS 110. Those activities, the decisions of which could impact the profitability of the investee would be considered as relevant in nature. So that was on the block number 1, and then we started a journey in terms of block number 2. And we are discussing the block number 2, of which I will now also give you brief and notes and do case studies as well. So once you've zeroed down that yes, it is a joint arrangement, the next concept what comes into account is to decide what is the type of joint arrangement. And we said the joint arrangement could be in terms of a JO or in terms of JV. It could be a joint operation or it could be a joint venture. And here again, I said we're going to first put a question and then apply a three-step model. We're going to work back on that. I just gave you some basic frameworks of thoughts. We're going to work on this. So, but I gave you very clearly in this particular case that when you're evaluating the type of the joint arrangement, there is a question to be put across and there is going to be a three-step model which you will apply in order to decide what is the type of joint arrangement. And then we went ahead and we said we'll do the block 3, which I am of course yet to do. So we said the block number 3 in terms of the standard is looking at the accounting. And this is in accounting in the books of the parties. This is accounting in the books of the parties to the joint arrangement. We need to see how would the accounting take place in the books of the party. This accounting would be in terms of, you can say, separate financials, consolidated financials, joint operations, as well as a joint control, all permutation combination. So we need to see the accounting in the separate financial statements, in the consolidated financial statements of a joint operators and joint venturers. This is not joint operation, not joint venture, it is operators and venturers. I think let's not put it as JOGV so it creates a confusion later. We are looking at the books of the joint operators. The parties are called the joint operators, or we can say the joint venturers. We can say the joint venturers are concerned. So this is the overall mind mapping in terms of how the standard is being organized. So we are now working on the block number 2, then we'll go to the block number 3 as well, where we're going to have a look at the accounting in the books of the joint operators in terms of JO, joint venturers in terms of JV, in the separate and in the consolidated financial statements as well. So let's, I think, come back to the block number 2 as well. Now, coming back to the agenda as far as the block number 2 is concerned, let's have a look at what is going to be the thought process in terms of block number 2. Now, I've given you a basic structure. Now we're going to go a little more deeper into it and look at the examples which are given in the appendix to the standard. Similar examples are given in the study material illustrations as well. So let me first give you the thought process. So we are deciding on the type of joint arrangement. We're looking at the type of the joint arrangement. For this, I took you to a chart. Let me first take you back to the chart and get the thought process very clear. Then I'll document the notes as well. No worries. We'll document the notes as well. So let me first take you to the chart. This is given in the standard and is also given in the study material as well. So let's just watch this very carefully. Then what is the thought process in terms of a joint venture or a joint operator? Now, there is a question which I need to put across to myself, and then I need to apply a three-step model if required. Get the words very clear. You need to first of all look at the structure of the joint arrangement. That is it structured through a separate vehicle, or is it not structured through a separate vehicle? Two parties enter into an arrangement and create a third entity. That's creating a separate vehicle. Or two parties enter into a joint arrangement but do not create a separate vehicle. So your first focus question would be to put across a question: did you create a separate vehicle or not? If a separate vehicle is not created, we are undoubtedly calling it as a joint operation. We're undoubtedly calling it as a joint operation. And for the reason, you can say the separate legal entity is not even established. The parties to the arrangement itself are, you can say, the entity. So they are not establishing any separate legal entity. So in this case, they will be considered as a JO. But if you say yes, a separate vehicle is created, then you need to apply a three-step model in terms of deciding whether it is a JO or a JV. So get this very clear. So what do you need to do? First of all, you need to put a question to yourself. The question number one, which you're going to put across, is a separate vehicle is created or not. If you say no, it's a JO, I'm done. But if you say a separate vehicle is created, you need to apply a three-step model. And this is my step number one, this is my step number two, and this is my step number three. Now let's get one thing very clear. The chronological order of the steps is going to be very important to decide. So what I need to do, first of all, I will apply the step number one, and I will definitely go to the step number two. I will apply the step number one and definitely go to the step number two, irrespective of whatever results comes out of step one. Your evaluation of the step number one can tell you it's a JO, it's a JV, but I'm still going to go to the step number two. Now, if the data of step number two is given, if the data of the step number two is given, I will decide the answer as per step two, and it will override the step one. Please get this very clear. If you are given the data in step number two, I will apply the data in step two, and the answer is the step two. It will override the inputs in step one. I know you will immediately say that if step number one is to be overridden, why did you apply step one? Don't get worried, you'll get the answer for that. So when you apply a step one, irrespective, you go to step two. If the data of step two is given, step two overrides the step number one, and I'm decided. But let's say if the data for the step number two is not given, I am supposed to go to step number three. If the data for the step number two is not given, I am supposed to go to the step three. Don't worry, I'll document the notes later. Now, when you go to the step number three in this particular case, the step number three data will may be given or not given. This data for step number three may be given, may not be given. If the data for the step number three is given, my step number three is going to override the step number one. My data in step number three is going to override the data in step one. And if the data on step number three is not given, then the conclusion as per step one becomes valid. Now you would get the inputs that why step number one is important. Step number one is going to be important only if the data for 2 and 3 is not given. Otherwise, if the data in 2 is given, it overrides 1. If the data of 2 is not given and 3 is given, 3 overrides 1. So once more, can you give the thought processes once more so we get a little more clarity in terms of things, right? I'll give you more clarity. Let me put the inputs once again. And by the way, friends, let me also remind you that we are going to get a little extension today because I left you a little early in the previous class. So I am going to extend the class till 10:30 today as well as on Thursday, which I already apprised you. Okay, let me just come back. So in this particular case, let me give you the three-step model once again. Get the data very clear, the chronological movements very clear in the back of the minds. When I'm going to apply a three-step model, you are going to first look at step one. What is to be seen in step one, we'll see. You're going to look at the step number one, and the step number one data will 100% be given. Don't think that data for step one will not be given. The data in step one will definitely be given. So whatever you decide in step one, you irrespective go to the step number two. Now, if the data in step number two is given, there is no need to go to the step number three. The answer as per step two will override the answer as per step one. If the data in step two is given, there is no need to go to the step number three. The step number two will override the step number one. Next, if the data for step number two is not given, I go to step number three. And when you look at the step number three, here again you need to see, is the data for step three given or not? If the data for step three is given, my step three will override step number one. And if the data for step number three is not given, then whatever conclusion you drew on step one is valid. So the order is pretty simple. I hope I am very clear on my thought processes. Correct? I hope I'm clear with the movement in terms of step 1 to 3, what is to be evaluated under each case. Great. Let's now look at what is step 1, 2, and 3. The step number 1 is looking at what is called the legal form of the separate vehicle. When the two parties organize a separate vehicle, they may organize it in different forms. They could organize a company. They could organize an LLP. They could organize even a normal partnership firm. So these were certain clarifications which were also given in the Ind AS bulletins a long time back. I guess if you're aware, then once Ind AS was implemented in India, there was also the Ind AS bulletins which were issued at that time. And what I'm telling you about the legal form was clarified in those Ind AS bulletins at that stage. And they said that when you look at the legal form, it may be organized as a company, or it may be organized as an LLP, or it may be organized like a normal partnership firm. Now, we need to basically evaluate in step number 1 that if you're creating a separate legal entity, the parties to the arrangement create a separate legal entity. We need to see that is the separate legal entity getting established or not. Is the legal form of the vehicle creating a separate legal entity between the parties and the third entity? In case of company, yes, it will create a separate legal entity. In case of LLP, yes, it will create a separate legal entity. But in terms of firm, the partners of the firm and the firm are not separate legal entity. A company would create a separate legal entity between the shareholders, you can say the members of the company and the company. But when it creates a partnership firm, it does not create a separate legal entity. So when it creates a separate legal entity, we're going to call this as a JV. And if it does not create a separate legal entity, we're going to call it as a JO. So in step number 1, you just need to see what did you establish. If you established a company or if you established a LLP, it's a JV. And if you say it's a partnership firm, it's a JO. But irrespective, whatever you decide in step 1, I am going to go to the step number 2. Now, in terms of step 2? We need to see the terms of the contractual arrangement. We need to see the terms of the contractual arrangement. Now, when I say the terms of the contractual arrangement, the interesting part can be the parties to the arrangement have created a company or they've created an LLP, but they decide with their contractual terms, they say, in a very idealistic situation, now hear this carefully. In a very idealistic situation, what would a company and what would a LLP ensure? That the parties, the members to the arrangement will get net assets, share in the net assets, and the share in the net profits. But when it comes to a partnership firm, the partners can decide to get a share in the assets. They may decide to get a specific share in the assets or the obligations towards specific liabilities, getting a shares in the revenues, getting the shares in the expenses. So the partners, the parties to the arrangement could decide that way. So which means that when you look at a company or a LLP, the party should ideally get what? Net assets, net profit. But when it is a partnership firm, what should they get? They should get a share in the asset, obligations and liability, share in the income, share in the expense. So we'll have to see that by entering into a contractual arrangement, what are they trying to decide? Are they going to give the parties net assets and net profit? Or are they going to give the parties assets, liability, incomes and expense? So we need to see that their contractual arrangement is deciding that what are the parties going to get. Is it in contradiction to creating a company? Which means, is it possible that you create a company but the parties will get assets, liability, income and expense? Yes. So the terms of the contractual arrangement is violating the concept that you're establishing a company, but by virtue of your agreements, you're overriding the concept. So if it is a case of net assets or net profits, it's a JV. And if it is assets or liability, if it is supposed to be assets or liabilities, then in this case, it is a joint operation. Which means in step 1, you decide it's JV. In step 2, you decide JO, it's a JO. In step 1, you decide JO. In step 2, you decide JV, it's a JV. But if you decide step 1, JO, step 2, JO, JO. So step 2 decisions will override the decisions in 1. And naturally, the contractual terms are trying to violate the legal form of the entity. So once the parties to the arrangement are entering into a contractual arrangement whereby they're trying to, override the separate legal entity, so we can say the step 1 becomes more like a litmus test. It's more like a litmus test where you're trying to see on the face of it, are they establishing a company or are they establishing a legal LLP or a normal partnership firm? But I need to see the substance of the legal form. Are you getting my point? The step number 2 is looking at the substance over the legal form. And our entire accounting is, of course, based on a substance of a legal form, that the legal form could ensure a JV or a JO. But you need to see the substance of the legal form. The terms of the contractual arrangement is deciding the substance of the legal form. But sometimes the parties may not have any clear-cut terms of the agreement. So data in step number 2 will become silent. And if the data in step number 2 becomes silent, then I go to the step number 3 and decide what are the other relevant facts and circumstances. Is there anything else which is given to the contrary? Is there anything else which is telling me that, no, it's not a JV as per step 1. No, it's not a JO, what you identified in step 1. So this data may or may not be given. And accordingly, we will have to evaluate and see the data that whether the circumstances are contradicting step number 1 or not. but then what kind of facts and circumstances are we going to look at? We'll discuss that as well. Let me just now consolidate the picture and make some documentations. We are still left with the step number 3, but we'll first see a question where data for step 2 is given so we can at least get a clarity in terms of thoughts. Let me now consolidate the picture. So what is the procedure? You're going to put a question, is a separate vehicle created or not? No, JO. Yes, 3-step model. 3-step model, we look at the legal form. Did you create a company or LLP? JV. You created a partnership firm? JO. Go to the step number 2. What are the parties getting? Are they getting share in net assets, net profit? JV. Are they getting asset, liability, income and expense? JO. And then step 2 overrides step number 1. Data step 2 not given. Go to step 3. Look at other facts and circumstances. If not given, decision as per step 1. If given, evaluate them. How? We'll see. I hope, friends, I'm clear with the picture, right? Let's do one thing now. Let's, I think, document the notes to you at this stage before we do a practical illustration. Let's get the thought process very clear. Great. So we are now looking at the identification of the type of joint arrangement. And for this particular purpose, you need to first of all put across a question and then move further. Is a separate vehicle created? Is a separate vehicle, let's underline separate vehicle, is a separate vehicle created? So did we create a separate vehicle is the pertinent question. So the answer could be a no or the answer could be a yes. If the answer is supposed to be no, we are done. It is supposed to be a joint operation. But if the answer is a yes, we need to apply a 3-step model in this particular case. If the answer is a yes, we would apply a 3-step model. Now let's see what is the 3-step model. First of all, in terms of step number 1, we will evaluate what is the legal form. What is the legal form? So let's underline the legal form of the separate vehicle. So we need to see what is the legal form of the separate vehicle. Whatever separate vehicle is established, what is the legal form? The combinations which could arise would be either we say it's a company or is it LLP, or I would say it's a normal partnership firm. It's a normal partnership firm which is created. So you'll have to see what kind of form the company is, the separate vehicle is established. If it is company LLP, it's a JV. And if it's a partnership firm, it's a JO. But irrespective, we'll go to the step number 2. So irrespective, we need to go to the step number 2. Even after evaluating, it's a JV or a JO, you're going to go to step 2. Right, so this is on step 1. Let's take it further. Let's go to the step number 2. So in terms of the step number 2, what we'll do, we will now see are the parties defining rights and obligations? Are the parties defining, I would say, rights and obligations? So are they defining the rights and obligations, underline rights and obligations, in the contractual arrangement? I'm putting it as CA. So are they defining the rights and obligations in the contractual arrangements? So it means there are 2 combinations. So they say that they will get a share in the net assets, they will get a share in the net assets, or they will get a share in the net profits. or they define that they're going to get a share in assets. They will get a share in the assets, or they will get the obligations and liability, share in assets and liability, and they will get share in incomes and expense. So you need to see what are they getting. Are they going to get a share in the net assets, net profit, or share in asset liability, income and expense? And accordingly, if this is the case, it's JV. If this is the case, it is JO. And we can say the step number two overrides. The step number two overrides step number one. The step number two is going to override the step number one. It's like substance over the legal form. Now let's also define out here in this particular case that in this particular case, if it is not defined. So this is, we are saying, yes, it is defined. So if the parties' rights and obligations are defined, it is so. If it is not defined, then we need to go to the step number three. So first is it defined or is it not defined? So if you say yes, it is defined, then accordingly we evaluate. If it is not defined, you go to the step number three. Now let's see what is the status in terms of the step number three. And step number three is evaluating. Step number three is evaluating other facts and circumstances. Evaluating other facts and circumstances. What is to be evaluated, we will see. I'm yet to discuss that what are the other facts and circumstances to be evaluated. So we can say there are two situations once you evaluate the facts and circumstances. We can say they contradict step number one. They contradict step number one. Then we can say step three overrides step one. Step three overrides the step number one. So in this particular case, it contradicts step number one, or it does not contradict. So it does not contradict step number one. So you'll have to see whether the data which is given for other facts and circumstances is contradicting the step number one or not. Then we can say the answer is the step number one. What have you decided in step one? Now here again, there will be two inputs which are there. The other facts and circumstances are given, then I'll evaluate them and decide the contradiction. Or we can say it is not given. If it is not given, then the answer as per step one is the deciding factor. The answer as per step one is the deciding factor. Right, friends, I've documented all the thought processes very clearly, telling you how the three-step model is to be applied in this case. You know, I've always been keenly working on the evaluations of the Ind AS into a step-by-step approach to make life simple. Sometimes people tell me applying a step-by-step is like converting this into a rule-based standard. No, it's not. It's only giving you clarity in terms of how the principle-based application is done. I think that's how the artificial intelligence AI also works. Am I trying to make you robots like artificial intelligence? Yes. Okay, so far so good. I think now we can apply this to a practical illustration. So let me now take you to the inputs in terms of an example which is given in the appendix to the standard as well. So let's have a look at an example which is also given in the study material as well. So we're now going to apply the three-step model in terms of whatever we have documented. Let's go step by step on this. Let's consider this. It says, assume that two parties structure a joint arrangement in an incorporated entity. So I think we put across the question. Did we create a separate vehicle? So we said yes, separate vehicle is created. So we can say the separate vehicle is created. So I need to apply my three-step model in terms of now doing a further evaluation step by step. It says each party has got a 50% ownership interest in the incorporated entity. The incorporation enables the separation of the entity from its owners. So when it says it enables the separation of the entity as well as the owners, let's look at the step number one. What does the legal form ensure? Would you like to tell me? When the separate entity is established and it ensures that the separation of the owners and the entity is there, JV or a JO. Can I say in this case, a legal form is ensuring that it is supposed to be a joint venture? Great. And then it says, and as a consequence, the assets and liabilities in the entity are the assets and liabilities of the entity. In such a case, now what do you need to do? You need to go to the step number 2 to see what is the contractual arrangement defining. In such a case, the assessment of the rights and the obligations, that's what I said. You need to evaluate the rights and obligations conferred upon the parties by the legal form indicates that the parties have rights to net assets of the arrangement. So legal form is telling me that it is indirectly saying that the parties are supposed to get a share in the net assets that ensures a JV. However, that is now the step number 2. The parties modify the features. When they modify the features through a contractual arrangement, so they modify the features. If they modify the features by a contractual arrangement, it can become a JO. So they decide, no, we will not ensure that the parties get share in net assets, but they are supposed to get the share in the assets and liability, becomes a JO. So that each gets an interest in the assets of the entity and each is liable for the liabilities of the entity in a specified proportion. So if they enter into a contractual agreement to ensure they get share in the assets, obligation towards liability, such contractual modifications to the features of the corporation can cause the arrangement to be a joint operation. So in this particular case, when you look at the step number 2 and 1, the conclusion is that the step number 2 will prevail and this will become a joint operation. Even though it is legally created in the form of a JV, but once the parties modify the arrangements by ensuring they get assets and liability, it becomes a JO. I hope you got the example 4 very clear. Okay, now let's have a look at another example as well. This is going to be now taking you to the step number 3. This is going to take you to the step number 3 as well. So let me, I think before that, also give you some insights of how the step number 3 is to be evaluated as well. So through this example, I'll give you inputs on the step number 3. So this is example number 5. And this is going to take us to the step number 3 as well. So let's, I think, read the inputs which are given in terms of example 5. This will make us walk through on the 3-step model and we're going to reach the 3rd step. We yet to understand what are the facts and circumstances to be seen in terms of step 3. I will first understand this through this example, then document the inputs to you. Let's, I guess, read example number 5. Assume that two parties structure a joint arrangement in an incorporated entity C, which means you've created a separate vehicle and therefore I need to apply my 3-step model in terms of deciding JV or JO, in which each party gets a 50% ownership interest. The purpose of the arrangement is to manufacture materials required by the parties for their own individual manufacturing process. So the purpose of the arrangement is that they want to manufacture materials for their own captive consumption. Own process means captive consumption. The arrangement ensures that the parties to operate the facility that produces the material to the quantity and quality specifications of the party. Now, if you look at the legal form, if you look at the step number 1, that is the legal form, we can say if they've created a company or an LLP, considering that it is an incorporated entity, which is, let's say, a company, it is a JV. So I need to go to the step number 2 to see that are they defining the rights and obligations in the contractual arrangements or not. It says the legal form through which activities are conducted initially indicates that assets and liabilities held in C are the assets and liabilities of C. So the legal form is ensuring that it is undoubtedly a joint venture, because it is giving the separate legal entity establishment. The assets and liabilities of C are the assets and liability of C, not the parties. The contractual agreement between the party, the contractual arrangement, step number 2, does not specify. So my step number 2 data is not given. My step number 2 data is not given. So in this case, we need to go to the step number 3. You can see the chronological order that once you look at the legal form, you go to the contractual arrangement, data is not given. It says the arrangement does not specify the parties have rights to assets or obligations for liability. So accordingly, the legal form and the terms of the contractual arrangement indicates that it is a joint venture. As of now, it indicates it's a JV, but I need to go to the step number 3 to look at other relevant facts and circumstances as well. However, it says, however, this is the step number 3. They also need to consider the following aspects of the arrangement. So now we're going to concentrate that what are the other relevant facts and circumstances which needs to be evaluated in this particular arrangement. Let's see. It says the parties agreed to purchase all the output produced by the entity C in the ratio of 50-50. Entity C cannot sell any of the output to third party unless it is approved by the two parties to the arrangement. Because the purpose of the arrangement is to provide the parties with output they require, sales to third parties are expected to be, you can say, uncommon and not material in nature. So he's giving me the inputs that this entity C is established with the objective that they will produce the output and 50% will go to first party, 50% second party. There will be no third party sale. That's the input given. Let's read further. Then we're also given the inputs that price of the output sold is set by both the parties at a level that is designed to cover the cost of the production and administration expense. On the basis of this operating model, the arrangement intended to only a break even. Now we are given two very important inputs which needs to be evaluated. Now watch the analysis carefully. If it clicks in the next 2-3 minutes. Let's evaluate this and watch me on this analysis. The relevant facts and circumstances which are given, there are two relevant facts which are given. Number 1, it says that as far as the 100% output of entity C is concerned, it is being given 50-50 to both the parties. It is being given 50-50 to both the parties. That is one. Now, watch the analysis. What is the output of the separate vehicle? isn't the output an economic benefit? Yes, sir, we can say that the output is supposed to be an economic benefit, which means that if you're looking at the output of the entity, the separate vehicle, the output represents the future economic benefits. And future economic benefits is synonymous with the word assets. Did you see the chain of thought? That when you say 100% output, the output of the separate vehicle is indicative of the future economic benefits the entity will arrange. So the future economic benefits is synonymous with the word asset. So does this mean that they are getting a 50-50 share in the assets of the entity? Oh, yes. Then there is another fact which is given, that the price at which it is sold. The price at which is sold ensures that there is only a break-even level. There is a break-even point. The prices at which the output is sold ensures a break-even. So does this mean that for the obligations of the separate vehicle, they are dependent upon the parties? The separate vehicle is not getting any returns. It is completely dependent upon its hand-to-mouth situation. It is completely dependent upon the money which will be provided by the parties. So which means if the price is ensuring a break-even, the parties are indirectly, you can say, meeting the obligations of this particular arrangement. So when I say meeting the obligations, it means that they are meeting the liabilities as well. So which means that the first fact indicates that they're getting a share in the assets. The second fact indicates that they are getting an obligations towards liability. So they've got rights to assets separate. They've got obligations towards liability separate, which means it's a joint operation. Wow. Let's read the analysis also further. It says the obligation of the party to purchase all the output reflects the exclusive dependence of C upon the parties for generation of cash flows. Thus, the parties have an obligation to fund the settlement of the liabilities. So we can say that since entire money which C gets comes from A and B, so we can say that this means the cash flow generated is going to be by the parties. So they're indirectly funding the obligations of the liabilities. Then he says the facts that parties have rights to all the output means that parties are consuming and therefore they've got right to all the economic benefits of the assets of the entity. So the arrangement is being structured in such a way that the output of C, which is the benefits of C, which is the assets of C, goes to the parties. And since there is a dependency in terms of the cash flow because it ensures a break-even point, which means the parties are basically funding the obligations, that is the liabilities of the entity, which indicates it's a joint operation. Then we're also given further inputs. These facts and circumstances indicate the arrangement is a JO. Step number 1 said it's a JV, but step number 3 tells me it's a JO, and 3 overrides step 1. The conclusion about the classification of arrangement would not change. Now he's giving you some clarification. He's giving you some clarification that even if you modify the facts of the case to me, how would the answer change or not? It says that the conclusion about the classification would not change if instead of the parties using the share of output themselves in a subsequent process, the parties sold their share of output to third party. So what is important is that if the output of C goes to A and B, whether they use it for captive consumption or whether they sell it to third parties later on, doesn't make a difference to my analysis. So the end use by the parties of the output taken by C. Whatever is the output of C is going to A and B. Now, whether A and B are going to retain it for captive consumption or whether A and B are going to sell it to third party would not make a difference. The important fact is C cannot make a third party sale. That is the important fact. So if the parties change the terms of the arrangement so that the arrangement is able to sell output to third party, let's say we consider that we can make a sale to third party, this would result in C assuming demand, inventory, and a credit risk. So the moment C is able to make a third party sale, you get inventory, you get demand, you get a credit risk of non-payments. In that scenario, a change in the facts and circumstances would require reassessment of the classification, and this would indicate that the arrangement is a joint venture. Superb. So this is interesting indeed. So I think the model of the story now, what is to be seen as a part of the step number 3, and I like to draw your attention to one very interesting flow chart which is given in the study material as well. So I'll just like to quickly take you to the chart as well. Let me just take you to another interesting chart which is given in the study material, which is evaluating the 3-step model and specifically the step number 3. So let's have a look at the chart which is in the study material. This is on the 3-step model in the study material. Now we're focusing on step 1, 2, 3. Can you now see? This is the step number 1, which we've already seen. This is the step number 2. And this is the step number 3. Step number 1, step number 2, and 3. Wow. These kind of flow charts were, enough for me to give me a food of thought of creating the step-by-step models. There are some very interesting flow charts which are given in the study material, which gives you a very good insight. I feel very happy, excited to look at these flow charts because they condense the entire thought processes in terms of wonderful conclusions. So step number 1 is the legal form of the separate vehicle. Step number 2 is the terms of the contractual arrangement. And step number 3 is looking at the relevant facts and circumstances. Now see what is given. Does the legal form of the separate vehicle gives the parties rights to the assets and obligations for the liability to the arrangement? So if the legal form is giving a separate right, yes, it is a JO. If it is no, you go to step number 2. You need to go to the step number 2. Now, do the terms of the contractual arrangement specify parties' rights to the assets, obligations to the arrangement? If yes, it is JO. If it is no, you go to step 3. So this part we've already seen, the step number 1 and the step number 2. Now it's time to look at the step number 3. What kind of evaluations are required in step 3? Have the parties designed the arrangement so that its activities primarily aim to provide the parties with an output? That is, the parties have rights to substantially all the economic benefits of the asset. In simple words, we can say there is no third party sale. You need to basically evaluate that there is no third party sale. You primarily created the entity with the objective that the entire output will be given to the parties with no third party sale. And the second condition, it depends upon the parties on a continuous basis for settling the liabilities relating to the activity. This indirectly means that the price at which things are sold is ensuring a break-even point. It makes them dependent on the cash flows. Once it makes them dependent on the cash flows, then in that case, it could be a JO. So if it is yes, it is a JO. If it is no, it's a JV. Let me elaborate the step 3. Let me make some notes as well. But I hope we got the picture clear in terms of facts and circumstances. Let's go back. Let's, I think, put the step number 3. Let's document the step number 3 inputs further to you. So let me just add the step number 3 details at this stage. So we've got the step number 3. This is the step number 3, which is looking at the other. I will call it as relevant. I did not make a mention relevant earlier, but let me use the word other relevant facts and circumstances. So I'll just make a little comprehensive movements of other relevant facts and circumstances. See what kind of permutations and combinations could arise out of this. So when you're evaluating the other relevant facts and circumstances, now, in terms of the other relevant facts and circumstances, I would say there are basically 2 conditions to be evaluated. I would put it like condition number 1, and I will put it like condition number 2. Now watch this carefully. You're going to see some very interesting inputs coming in. So I would say there are 2 conditions. One is condition 1 and one is the condition number 2. Now what is the condition number 1? The condition number 1 is we need to consider that is there a third party sale? So we need to see that is there a third party sale which is allowed? Or let's put it like this, let's put it like this, that is a third party sale allowed? So let's put it like this, that is a third party sale allowed? So we need to see that is a third party sale allowed or not, because that would be the deciding factor. So if you say that a third party sale is not allowed or it is allowed. So if you say it is not allowed, or we can say it is allowed. If you say a third party sale is allowed, then in this particular case, you can say that it is getting independent demands, it is getting inventory, it is getting credit risk. So when you say that a third party is allowed in this case, third party sale is allowed, it gives the separate vehicle. It gives the separate vehicle, you can say demand, it gives them inventory, it gives them credit risk. It gives them inventory, it gives them credit risk. And therefore, I would say it would become a case of joint venture. But if you say that in this particular case, the third party sale is not allowed, we are ready to go to the condition number 2. We are ready to go to the condition number 2. And in this case, when you say it is not allowed, this is basically indicating that entire output that is future economic benefits, the future economic benefits, brackets, I'm putting it as assets, belongs to parties. So this is indicating that first condition is met. And let's also put it out here as a clarification. Let's put this as a clarification out here. Parties after taking the output. So the parties after taking the output may use it for captive consumption. So they may use it for captive consumption or further sale. So that is also an interesting fact which came in the example. That we can say parties after taking the output may use it for captive consumption or further sale. So they may use it for captive consumption or further sale. So even if this be the case, it has got no impact on the analysis. So whether they are able to make a third party sale later or they're going to use it for captive consumption. So what the parties will do at a later stage is not going to affect my analysis. What is important is that this separate vehicle cannot make a third party sale. So if it cannot make a third party sale, it's the end. Now what the party will do after taking the output, use it for captive consumption, use it for further resale, doesn't impact the analysis. And then comes the input in terms of the condition number 2. And the condition number 2 is prices at which prices at which output is sold. Prices at which output is sold ensures break-even point. So it ensures a BEP. So the prices at which output is sold ensures a break-even point. So what does this mean? This means dependency. This means dependency on cash flows. Dependencies on cash flows from parties. And dependencies on cash flow means that they are meeting obligations. That indicates that they are meeting obligations, which means liabilities. And this will indicate that it is supposed to be a joint operation. Right, friends, so far so good. I guess I've given you the detailed analysis of all the 3 steps to be applied in terms of evaluating it's a JV or it's a JO. I hope, friends, you've well understood my entire analysis. The question to be put across, the 3-step models to be evaluated to decide whether it's a JV or it's a JO. Correct? Okay, now let's take it further. Having understood this, now we're ready in terms of going to the block number 3. So this was my block number 2. I'm just going to remind you back in terms of where we started a journey today. So we done the block 1. Is it a joint arrangement? Block 2, what is the type of arrangement? Now comes the question, what kind of accounting is to be applied? My mind is running quite wild in terms of thinking the different permutation combinations which could arise in terms of accounting in separate and consolidated financial statements. Stop me from making a drastic chart. Tell me, no, sir, just give it a simple chart. Don't complicate it. I'll not give it to you. You've got the right to stop me not to give you a complicated chart. So tell me, no, sir, you can give us a simple chart. Don't give us a complicated chart. Say yes, no, we don't want it. Your silence is taken as a deemed acceptance for this purpose. Your silence is being taken as a deemed acceptance on this nature. Thank you very much for the inputs of being silent. Now, I want to first of all take you to the accounting treatment. We are now on the block number 3, and in terms of the block number 3, we're looking at the accounting in the books of parties. Let me tell you, the standard is not telling you accounting in the books of JO. The standard is not telling you accounting in the books of JV. They're telling us what is the accounting in the books of the parties. The parties to the joint operation are called joint operators. The parties to the joint venture is called the joint venturers. So the standard is telling you the accounting in the books of the joint operators and the joint venturers. Let's have a look. So I am given, it says accounting for interest in joint operations in the separate and in the consolidated financial statements of a joint operator. That's what we said, that we are looking at accounting in the books of the parties. A joint operator shall recognize in the separate and the consolidated financial statements. That means there is a common treatment whether it is a separate or is it a consolidated financial statements. It will include its assets and the share of any assets held jointly. It will consider its liability, including the share of any liabilities incurred jointly. It will consider its revenue from sale and its share of the output arising from JO. It will consider its share of revenue from the sale of the output by the joint operation. And it will consider its expense, including any share of expenses incurred jointly. It would not be technically correct, but I think I can still use the word, which standard used to use earlier, that is called a proportionate consolidation method. If somebody were to ask me that what are the various methods of consolidation available under Ind AS for consolidation point of view, I would say there are basically 3 consolidation techniques. One is, I would say, is a full consolidation, which is applicable to a subsidiary under 110. Another, I would say, is a one-line consolidation, which is applicable to an associate under Ind AS 28. And other is, I would say, a proportionate consolidation, which is applicable to a joint operation, not joint venture, under Ind AS 111. Now, why do we call it as a proportionate consolidation? Though I said we should not use this word, because we may not add up only 40% assets, 40% liability, 40% revenue, 40% expense. It can be a different percentage as well. The parties to the arrangement may be entitled to 40% assets, but maybe 30% liability and a different percentage for revenue as well as expense. But for understanding, we can call it as a proportionate consolidation, because you need to consider not the entire assets, liability, income, expense, but only your share. So when you say that you're going to consider the share in the asset, share in the liability, share in the output, share in the expense, it's all about proportionate consolidation. So in a subsidiary, you consolidate full irrespective of the percentage. In a joint operation, you say my share. And in terms of an associate and a JV, because the moment you're going to be JV, you're going to shift to Ind AS 28. And in terms of JV, you are going to basically apply what is called one-line consolidation. We've got the basic flavor earlier. So let's have a look at illustration number 21, which tells you how the accounting for the interest in a JO is done. P and Q form a joint arrangement PQ using a separate vehicle. Aha! If they're creating a separate vehicle, I need to apply my three-step model in terms of deciding whether it's a JV or is it a JO, because a separate vehicle is established. P and Q each own a 50% capital of PQ. However, the contractual terms of the arrangement state P has got rights to all the machinery and the obligation to pay the bank loan. P and Q have rights to all other assets and obligations and all other liabilities in proportion to the share of capital. So they've decided by a contractual arrangement that one party gets the entire machinery. He gets the entire bank loan and the other assets liability 50-50. So the step number one, you can say the legal form may ensure that it's a JV. But when you go to the step number two and you look at the contractual arrangement, it overrides and it is a JO. And step two will override the step number one. So therefore, we can say it becomes a joint operation because the contractual terms of the arrangement have decided otherwise. Now, this is the balance sheet of the separate vehicle given to me. The capital, the bank loan, other loans, machinery, and cash. How should P record in its financial statements rights and obligations in terms of PQ? So let's see. He's going to just take the share, what is stated. So let's have a look at the inputs in this case. There are two illustrations which are given in the study material on the joint operations part. It says under Ind AS 111, P should record the following in its financial statements, separate or consolidation, whatever the case might be, because the treatment is common. And it says machinery is going to be taken full. He's got the entire 100% machinery. Cash, we have taken 50% because all other assets and liabilities getting 50%. Even the capital is 50, but bank loan is 100%. This is the instructions as per the question itself. And he gets a 50% other loan as well. As per the contractual arrangement, he is getting machinery full, bank loan full, rest of the assets and liability 50-50. So that's also the reason that it is a joint operation. Similar question is given, that is question number 22. I think this is absolutely similar. So you can try this out. It is absolutely similar. Illustration number 22. So the answer is also quite similar indeed. Once you read the contractual arrangement in this case, you'll come to know that AB has got the entire rights to the building and therefore it records it entirely. The building is recorded fully. And it has got an obligation for the debt owed by PQR in its entirety. So debt is also taken full. The building is 100%, the debt is 100%, the rest is based on the contractual arrangement. Absolutely similar question. So I think we got the connect in terms of accounting of a JO in the books of the joint operator, separate consolidation, same treatment. Now watch the next case. That is accounting for joint ventures. And then I'm going to make a chart based on this. So we've seen the accounting of a joint operator. The accounting in the books of joint operator is addressed by Ind AS 111. But accounting as per as a joint venture is concerned, it shifts you to Ind AS 28. It takes you out. Now, watch this carefully. Accounting in the books, accounting for joint ventures, it is consolidated financials and it is separate financials. And you'll see something more as well. Before I read this, I want to draw your attention to one of the examples which we did in the previous class. And I would like to draw your attention to that particular example. Please watch the example again. If you remember, there were three parties, A, B, C. A had a 50% stake, B had a 30% stake, and C had a 20% stake. And at that particular stage, I also told you that to take decisions, let's say we need a 75% majority. And we said A and B can achieve that combination. We said that A, B, C cannot take decisions alone. There is a collective control. Can C block decisions if A and B join hands? The answer is no. C is a party which is a party to the arrangement, but he's got no joint control. C is a party to the arrangement without a joint control. And I said the parties which are, party to the arrangement without a joint control, their accounting is going to be different as compared to A and B. And now you'll see there is a clarification. Accounting by an entity that is a party to the joint venture but does not have a joint control. Are we looking at C? Yes, of course. It is accounting by an entity which is a party to the JV but it does not have a joint control. So let's, I think, now see the treatment in CFS, then SFS, and for the party which is supposed to be not a party to the joint control. Let's read. A joint venturer, it's a books of the party, shall recognize its interest in a JV as an investment and shall account it using equity method as per Ind AS 28, unless the entity is exempted by applying equity method as specified in the standard. Now, the exemptions of equity method is what we are going to learn very shortly, maybe today itself. Let's go ahead. Accounting in the separate financials. In the separate financials, a joint venturer shall account for the interest in JV in accordance with Ind AS 27, which is going to be discussed in Unit 7. But it's going to be recorded at cost or fair value, your choice. I'll mention that. Then he says accounting by an entity, a party that participates it but does not have a joint control. It says shall also account for interest in the separate and the consolidated financials as follows. As follows. And if you remember, I told you, you'll have to evaluate whether it has got a significant influence or not. I made a mention at that stage as well that C will evaluate the presence of significant influence. If yes, he would apply 28 for console, otherwise 109 financial instruments. So whether the party has got a significant influence, if you say no, it is accounted under 109. If you say a yes, in separate and consolidation 27 and 28 respectively. So we're a little mix up in terms of which standard when. You want me to create a complicated chart in terms of giving you the permutation combinations for all the kinds of parties in separate and consolidated financial statements and give you a comprehensive overview of all the permutations and combinations? Yes. Okay. So let's make your life simple on that. I am now going to make some chart at this particular stage. Let me go back to my block number 3. So we're going to make some interesting chart at this stage. This is my block number 3. So we're done with the block number 1 and 2, which is on, is it a JA? What is the type of arrangement? Now on the accounting front. So let's take you to the accounting front first of all. So I'm going to make a chart. Try answering the questions as I give you the inputs. You'll get more clarity. So I am looking at the accounting in the books of the parties. We're looking at the accounting in the books of the parties. So we're looking at accounting in the books of the joint operators and joint venturers. So when I say the books of the parties, we're looking at the joint operators. We're looking at the joint operators in JO, and we're looking at joint venturers. We're looking at the joint venturers in joint venture. So the focus is accounting in the books of the parties. Let's create a wonderful chart out here. So my mind is now working in terms of different permutations and combination. So I'm thinking that we can consider, I'll give you the thought process. I'm considering that what we need to consider, accounting in the separate and consolidated financials, joint operators when they're parties to the arrangement and they've got a joint control, or they're parties to the arrangement and they've got no joint control. Similarly, in terms of parties to the joint arrangement, when they've got joint control, when they've got no joint control. Oh my God. So what I am thinking, first of all, is to look at the broader picture. Joint operators. I'm looking at accounting in the books of joint operators. I'm looking at accounting in the books of joint venturers. And I am further looking at the treatment in terms of separate and in terms of consolidated financials. So we're looking at the treatment in the separate and in the consolidated financials, separate and in the consolidated financials. That makes it a total of 4 cases. Let's add more. So we're also looking at now the 2 inputs. That makes it total 4 plus 4, 8. So these are 8 permutations and combinations which can arise. So this is for the parties. This is for the parties with a JC, and this is with the parties with no JC. They are parties without a joint control. So they are parties with a JC, parties with no JC. There are parties with a joint control and parties with no JC. I hope you got all the permutations and combinations clear. So we're looking at 8 permutations, combinations in this case. Let me put the thoughts back again to you. We're looking at accounting in the books of joint operators, in the separate and in the consolidation, parties who have joint control or parties who have got no joint control. Similarly for consolidation, similarly for joint venturers, separate and consolidation. That makes it a complete chart. Let's begin the journey. So we'll first of all tell you something simple. As far as a joint operator is concerned, it doesn't make a difference to me whether you're talking of a separate or a consolidated financial. It doesn't make a difference to me whether you're talking of a party with a joint control or a party without a joint control. So let me make it one thing very clear at this particular stage, and that is, we are saying that in this particular combination, it doesn't make a difference at all. I am technically going to use what we can call it as a proportionate consolidation technique. You can use a technique which is called proportionate consolidation technique. Though let me tell you, it is not technically correct. It is not technically correct to use the word proportionate consolidation. I'm putting it again. So don't please take that disclaimer. It's not technically correct to say that it's a proportionate consolidation, but for understanding. So which means what are you going to do in this case? I will take the share in the assets, liabilities, incomes, and expense. So when you're going to do the consolidation, or you're going to make your separate financials, in your separate financials, in your consolidated financials, you'll take the share in the asset, liability, income, and expense, irrespective, separate consolidation, whatever, it's called a proportionate consolidation. Now let's see the other inputs in this case. Now in this particular case, I am looking at a joint venture. Now let's first get one thing very clear. I made this chart at the start of Ind AS 103 also when I did the concept of business combination, and the same concept applies. In a separate financials, you are required to follow Ind AS 27, where the investments will be accounted at a cost or a fair value, your choice. But in a consolidated financial statements, you would apply Ind AS 28. Because once you establish a joint venture, you can say the parties will account for separate financials as per 27, cost or fair value, and it would be Ind AS 28 for consolidation. So let's look at the parties who have got a joint control. So in separate financial statements, they would apply Ind AS 27, where you will consider the investment in the balance sheet at a cost or at a fair value. The investment will appear in the balance sheet as cost or fair value. And if you look at the consolidated financials, then you are going to apply Ind AS 28, which is reflecting the investment using what is called an equity method of accounting, which you'll learn in detail further. So when you're looking at a separate financials, then it is supposed to be Ind AS 27. Cost or fair value, investments will appear in the balance sheet. And even in a consolidated financials, the investments will appear as a one-line consolidation that is called equity method. Now let's come to the parties which have got no joint control. So in this case, you need to make an assessment. You need to see whether significant influence is there or not. Either we say yes, there is a significant influence, or we say no, there is no significant influence. So if you make an assessment that there is a significant influence, trust me, you can again apply Ind AS 27. You can again apply Ind AS 27 in this case, because the standard treats a joint venture and an associate on the same platform. The accounting of a JV, the accounting for an associate are both under Ind AS 28. So this party is saying that the investee is my JV. This party is saying the investee is my associate. They'll do the same accounting treatment. But if you say no, in that particular case, I am supposed to apply Ind AS 109. And you will record the investments at a fair value through P&L or fair value through OCI. Because when you say that I've got not even a significant influence, you're a passive investor. And if you're a passive investor, the investment would appear as per 109 FPTPL or FPT OCI according to the concepts of 109, what you've done. Now let's come to the fact when you say that it is a consolidated financials. Here again, you need to do an assessment. Here again, you need to do an assessment of a significant influence. Is there a significant influence or there is no significant influence? So if you say yes, there is a significant influence. If you say yes, there is a significant influence, then in this particular case, I am back to the equity method. So you can see the interesting part. A party with a joint control, calling it as a joint venture, 27. A party without a joint control, calling it as an associate, again, same standard, otherwise 109. A party in the consolidation saying it's a JV, it's 28. If he says no joint control but single influence, still 28. And if it is no, then there is no consolidated financial statements. You are going to apply Ind AS 109 itself. And you will record the investment in the balance sheet at a fair value. Because then there is no consolidation, you're a passive investor. So this is the entire journey which you need to understand as far as accounting is concerned. There are no questions on this area because all this will be tested in terms of Ind AS 28. So there are questions only on this particular area, and here the life is simple. Because when you're looking at the books of the joint operator, it does not make any difference whether it is separate, whether it is consolidation, whether the parties have a JC, the parties have no JC, the treatment is same. The distinction needs to be very clear when you call it as a JV, then you need to be very conscious that is it a case of JC or no JC, separate or consolidation, and the treatments will apply. Right, friends, I hope I am pretty clear with the picture of my block number 3 as well. So far, so good. I hope you got the picture. Ind AS 111 is over on this. Now we need to take you to the journey in terms of the next standard. Somebody also requested me, I think Ginny, you requested me, I guess, to do a question in terms of May 24 examination question, right? I think you made a request to me for that. If I rightly remember, you made me a request or somebody else made me a request.
Sir.
You made me a
Yes,
request
sir.
for that. I am carrying that question on your request today. So you've got a choice now. You want me to do that question first, or you want me to first do Ind AS 28? Because that question got some concepts on Ind AS 28 as well. So we have some background on 28. If you want, before I start 28, I can do that question. Let's go with the majority choice.
Sir, first complete 28 in days, then we
Okay.
will do the question.
Then that question gets its turn in the next class, maybe. We have some background. If you want, I can do the question at this stage
Okay, sir.
also. It's not a big deal.
Okay, sir, then we can continue with the question.
Okay, then let me share the question to you. This is the question, Mr. Ramesh Khanna. This is the question which is the May 24 examination question. Let me just first crop this up. So this is a very interesting question because this, had some few new interesting points in the question. I think due to which, many people got a little afraid, and therefore, I think we are looking at this question now. So let me, I think, first give you the insight. Let me just read the questions to you. We'll just first have a look at this question. This is May 24 examination question. So let me pinpoint, this is May 24 examination question. And it contains both a subsidiary and an associate as well. I'll just first read across, give you some thought processes in the question, then we'll solve it. I think before that, once we're done with the analysis of the question, we'll give you a break also at that stage and then take it forward. It says the accountant of Mr. Ramesh Khanna of H Limited. When it starts up with the input Mr. Ramesh Khanna, somebody would, actually get into the point that it's an individual. This is not the company of Mr. Ramesh Khanna. Mr. Ramesh Khanna is the accountant of the company H. So it says the accountant, Mr. Ramesh Khanna of H, submitted to you the following balance sheet on March 24. So we are given the balance sheet of H, S, and A. Now we like to look at a little inputs that there are 14,000 shares in S and there are 4,000 shares in A. I'll just like to take you to the liability side of the balance sheet to do some calculations to begin with. So in this particular case, we can say if you look at the equity shares, the shares are 10 rupees each. That means there are a total of 20,000 shares. And in this case, there are a total of 10,000 shares. So we can see the equity share capital is 20 and 10. Let's come back on the percentages. So can you tell me that if he's got 14,000 out of 20,000 share, what is the percentage? I guess 70%. 14 out of 20, that makes it a total of 70%, and this is 4 out of 10, that makes it 40%. So I think one thing is pretty clear, that S is supposed to be a subsidiary, Ind AS 110, and A is supposed to be associate, so it's going to be Ind AS 28. Now let me tell you one thing which people do have a little confusions at time. If you give me a question where there are two subsidiaries, for example, or you give me a question where there is a subsidiary and there is an associate, trust me, it really doesn't make much difference to me. Because whether you give me two subsidiaries or you give me one subsidiary and one associate, I am going to apply my 7-step model in both cases. Does this mean in terms of I'm now looking at a subsidiary and associate? Does it mean that in terms of step 1, I'll look at the percentage and the acquisition date? Yes. Does it mean in terms of the step number 2, I am going to do the analysis of both the subsidiary and the associate? Yes. And I'm also going to go to step number 2B, get the net assets of both the company. Does this mean in terms of step 3, I'll organize the PC, the investment for both the company? Yes. Does it mean in step number 4, I'll calculate the NCI for both? No. NCI will be only for the subsidiary, not for the associate. And then I go to the step number 5. Does this mean that I calculate a goodwill for both the companies? Yes. Except that goodwill for the subsidiary would be a separate line item, but goodwill in terms of associate would be inner column disclosure. Then you go to the step number 6, but I would say before you go to the step number 6, you should get the investment value in the associate. I already gave you some inputs regarding how does the accounting for equity method works, where you need to basically consider that if the net assets of the associate changes, so would the investment balance also change. So I would say that you should add a step number 5A. When you're doing your 7-step model, in terms of step number 5A, add a new step, get the investment as per the equity method for one-line consolidation. Then you go to the step number 6, as you consider post-acquisition share in subsidiary, you also consider post-acquisition share in the associate as well. And then finally, in terms of step number 7, what do? When you consolidate the subsidiary, it's going to be a full consolidation. When you consolidate the associate, it's going to be a one-line consolidation. So the process of doing the question is again going to be a 7-step model, except that NCI will not be computed and a new step number 5A will be added, which we'll see when we come to the questions across. Now, let's take it further. Let's now read the inputs in the question. Now, we're given some additional information in the question, and I am given the following additional information is given. H purchased the shares in S on 31st October 23. Now, if I just want to look at the date of the balance sheet, it is March 24. The shares are acquired on 31st October 23. Now, remember, 31st October is not the middle of the year. Sometimes you tend to go wrong. It's not 30th September. It's 31st October when the retained earnings are given and the shares are acquired in A on June 23 when the retained earnings are given. This will help me to do the analysis of equity. Inventory of A includes inventory which is valued at 60, purchased from H on January 24. Now, this is not a sale between the parent and the subsidiary, but it's a sale between the investor and the associate. It says inventory of A is including goods which were purchased from H. It is again a downstream transaction holding to associate. And when it is going to be a downstream transactions, the stock of the associate doesn't appear in a balance sheet. So what we're going to do, we'll apply this in the equity method. So no worry, we'll take care of this downstream stock reserve calculations as well. Trades payable of H includes 25,000 payable to A and the amount receivable being recorded in the receivables of A. There is an intercompany owing between the investor and the associate. He is not giving you a stock reserve between the parent and the subsidiary. He is not giving you intercompany owing between the investor, between the parent subsidiary, but everything is related to associate. And in terms of associate, the payables, the assets and liabilities of the associate does not appear in the balance sheet console. And if assets and liabilities are not consolidated, I think this is irrelevant to me. I'm not concerned with elimination of intercompany owing. So this adjustment practically will be of no use to me. Then he says goodwill in respect of S has been fully impaired and the recoverable amount of the investment in A exceeds the carrying value on March 24. So for the subsidiary, the goodwill is impaired, but for the associate, the recoverable amount of the investment is more than the book value, which means there is no impairment for the associate company. The NCI is valued at a proportionate share of net assets. The moment you see that in this particular case, the NCI is at PASNA, it should immediately click to your mind that goodwill is supposed to be partial in nature. And when you say the goodwill is partial in nature, we should also be immediately able to link that the goodwill impairment is going to be borne by the holding company only. Is going to be borne by the holding company only in this case. We've seen that in Ind AS 103, that when you are considering the concept of a full goodwill or a partial goodwill, accordingly, the impairment is supposed to be borne by the parent or by the NCI. Since NCI is at PASNA, the goodwill is partial and it's borne by the parent company only. Now come some more interesting inputs at this stage. Some more inputs which are given, and so far if you notice, there was some intercompany owings between the investor associate, and there was a stock reserve and all, but suddenly out of the blue there are some more adjustments coming in. Now it says 10% dividends were declared by both the companies, whereas A associate declared a 15% dividend for 23-24. We already know as per Ind AS 10 that when a company declares a dividend, there is no obligation which is created. You cannot incorporate that as a liability in the balance sheet of the company. And I think if you like to go back on the balance sheet on the liability front, do you see any amount of dividends which are appearing in the balance sheet? No. Because this dividend is supposed to be only reflected in the notes to accounts. Because when a company declares a dividend for the current year, the dividend is only in the notes to accounts. So when it says that both companies declared a dividend, A declared a dividend, how does it make a difference to me? It's an irrelevant information. I can simply ignore it. Though I think in the suggested answer, different variations were given, but I'm going with the first variation itself, which makes logical sense to me, that if the company declared a dividend in this particular case, it is something which is in the notes to accounts. How does it impact my consolidation process? Then it said a new information which had never come earlier. On March 24, S made a bonus issue, one for every 2 shares held by the shareholders of S. Now that was a triggering point. People would have got confused on this issue because this was the first time when a bonus impact was given as a part of the consolidation. I'll now like to do some analysis, but let me read first. Then I'll give you some analysis which is there. It says dividends were declared but were not accounted for all these companies in the books before the year end. Similarly, the bonus issued by S was not reflected in the balance sheet. He says the dividends was in the notes to accounts and was not accounted by either company. Good for me. Ignore it. Now, the question arises that if the bonus is not reflected, can I also ignore the bonus as well? Yes, I can. Please hear me carefully. I'm going to give you analysis. There was also a note which was given in the suggested answer, but let me first explain the concept of bonus. Now, watch this carefully. I'll just like to do a little analysis at this particular stage. Let's consider a small little input. Let's consider this is my SOKI. Let's consider this is my SOKI, where I am considering only 2 tabs at the moment. This is my statement of changes in equity. This is my tab 2. This is my tab 3. This is my retained earnings in tab 2. Now, in the balance sheet of the company, you've got equity share capital, and in the balance sheet, you've got other equity, and this other equity is elaborated by SOKI. Let's just concentrate this very well. Let's say the company is got, I'm taking arbitrary figures not based on this question. Or let's take the figures based on this question only. I think that would be great to understand. Let's go back. Let's first of all have a look at the equity share capital. The subsidiary company has got a total of 20,000 shares. And if you look at the retained earnings, it is 750. So we've got total 2 lakhs and 750. So let me note down the figure. The equity share capital is 2 lakh and the other equity is 7.5. Now let's read what is stated out here. It says the bonus issued by S is not reflected in the balance sheet on March 24. The balance sheet which is given to you is without incorporating the bonus issue. The share capital of the subsidiary is without bonus issue. Now, it says the bonus is made 1 share for every 2 shares. 1 share for every 2 share means the bonus is 1/2. That means 1 lakh is the bonus issue. Now, imagine, what are you going to do? What are you going to do in this particular case? If I were to say, let me take the figure, which is after the bonus issue, this becomes 3 and this becomes 6.5. If you consider the bonus issue, this is 2 lakh will become 3 and the 7.5 will become 6.5. But what is the total equity? It's 9.5. What is the total equity? It's 9.5. The total equity of the company pre and the post bonus issue remains the same, and equity share capital of the subsidiary never appears in the consolidated balance sheet. So am I concerned in terms of making a balance sheet post bonus issue? You want to do it, you do it, but it really doesn't make a difference to me, because this in any case will not appear in the consolidated balance sheet. So whether it is 2 to 3 doesn't make a difference. So but when you are going to consider the step number 2B, okay, now watch that also part very carefully. Now, in this particular case, we are also given, if you go back to the retained earnings, in the point number 1, it says that the acquisition happened on 30th June when the retained earnings are supposed to be, H acquired shares and S on October when the retained earnings are 5 lakhs. Now, watch this further. The retained earnings on the date of acquisition. The retained earnings on the date of acquisition is 5 lakh. Now watch this carefully. If you want to get the figure of post-acquisition, I compare the 7.5 and 5 lakhs. So, but they are not correct. No worry, let's compare it. So we can say this is the balance on acquisition date, this is the balance at the end. So we can say 2.5 lakhs is post-acquisition. Now you say, no. I want to consider bonus issue. It's okay. Then the figure after the bonus issue is 6.5, but then you cannot compare 5 lakh versus 6.5. Because in this particular case, if you consider the bonus issue, then this figure is going to get reduced to 4 lakh because of the bonus. You compare this 4 and 6.5, you still reach 2.5. So in this particular case, what was the thought process is, you compare the other equity pre-bonus versus the other equity pre-bonus. The post-acquisition is 2.5. You consider the other equity post-bonus and the other equity on acquisition date post-bonus. Your post-acquisition is going to be same, which means it doesn't make a difference to my analysis of other equity, which means that my step number 2B in terms of sum total of the net assets, share capital, other equity would still remain the same. How does it make a difference to me in that case? So does this mean that I can simply ignore the bonus issue as well? I can ignore the bonus issue in this case. I don't need to incorporate. So if you want to make an extract balance sheet and proceed with the bonus issue, you can. You want to ignore the bonus issue and proceed with the question, you can. So in this particular case, now if I just look at the note which is stated, see what is given. The bonus issue by a subsidiary is a transaction with owner in their capacity as an owner. Therefore, bonus is only a transfer from one component of equity to another component of equity, not changing the equity. That's what we proved. It is 9.5, it is 9.5, it's just a component change. Accordingly, the bonus issue shall be accounted in the individual financial statements of subsidiary. The same does not have any effect in the consolidated financial statements of the group, which means I can ignore. So now if you see, dividends given is being ignored, the bonus issue is being ignored. So effectively, all this adjustments is gone. So what am I left over in the question is, this is analysis, this is stock reserve, this is intercompany owing, this is irrelevant because it is for associate. So there is only a stock reserve and a goodwill impairment. That's it. There is only a goodwill impairment and a stock reserve calculation. There is nothing else in the question. Let's further read this as well on the dividend fronts. This is the three solutions which the institute gave in the suggested. Since the adjustment number 5 and 7 of the question states that dividend has been declared by the entity, but no information is provided whether it has been paid or due. In this regard, it is noted that dividend is paid for the entire year. It is assumed final dividend is approved in the AGM at a later point of time. Accordingly, assumptions are taken on three fronts. Ignore the adjustments. Consider the dividend is declared but not paid. Consider it is declared and paid. I'm going with the assumption number 8, which makes more logical sense to me. Because in this particular case, when a company declares a dividend for a previous year in the current year, it's only reflected in the notes to accounts. As per Ind AS 10, it cannot appear in the balance sheet. So that is the logical presumption. So in this particular case, my adjustments of dividend gone, bonus issue gone. My life is made simple. I hope the analysis is done. I will do the question, but I hope the analysis is done. I think most of the question, part of the question would have got answered at your end, right? 7, these transactions, we should only put a note in the exams. Yes, of course. But I think, Ginny, many of the questions, concerns which were coming out of the questions would have automatically got addressed as of now. Yes or no? We'll do the question. That's not a worry. Yes, that's wonderful indeed. Okay, so I think now it's a little time to give you a break as well. I've stretched it a bit. Today I'm going to give you a little extended class as well. As I said, I need to compensate you for the time which we, didn't make up on Sunday. So I am going to extend the class till 10:30. So bear with me. We are going to do this question, and we also need to start with the concept of associates as well. Though I don't know, I might run short in terms of associate timings. We'll try to do this question quite fast. So let's take a break. We'll see you in around 12 minutes or so, 10 to 12 minutes or so. Enjoy your break. Relax your minds. We do this question. Okay, thank you. I guess you had a relaxation of mind. Now let's, I think, come back to this May 24 examination question. We're going to solve this on a 7-step model. So let's begin the inputs with you. So we're going to organize the data as we decided on a 7-step model. Just add in that one step which I said, that is step number 5A, where we need to get the investment as one-liner. So let's begin with, first of all, let me put the heading May 24 examination question. And let's first of all start with the step number 1. So let's, I think, first have a look in terms of the date of acquisition and the percentage. So we need the date of acquisition and the percentage for both the companies. One is holding in subsidiary and one is holding in associate HNA. So I think you'll have to give me the data as well because I'm not carrying the question with me. So if you can just quickly give me the inputs if you have the question with you in front. What was the date of acquisitions and the percentages in this case?
Sir, holding to subsidiary, it is 31st October 23.
Wonderful. 31st October 23. And the percentage, I think, was 70, right?
Yes, sir.
Okay.
And the second one is 30th June 23.
30th June 23, and this was 40%, right?
40%, yes, sir.
Wonderful. So it's except that, we are just organizing two inputs simultaneously. So this becomes my step 1. Now let's go to the step number 2A. So in terms of step number 2A, I need to organize 2 analysis. So I'll do the step number 2A. We will do the analysis of both the subsidiary as well as the associate. So let's take the analysis of the other equity. So we're going to take the columns and, fortunately, of course, we don't have any fair value adjustments or in terms of any stock reserve per se other than that. So that is upstreams are not given, it's all downstream. So we'll just take a column for particulars pre-post, organize the analysis for both the subsidiary and the associate. First, we'll define in terms of dates. This is particulars. This is going to be pre 31st October and anything from 1st November, and the balance sheet was 31st March 24. That becomes post. So careful on the time ratio as well. Your time ratio is going to be 7:5. And though we may not need that, so this is particulars pre, this is 30th June 23, and the post is going to be 1st of July till 31st March 24 is post. So this is for the subsidiary, we're doing the analysis, and this is for the associate, we are doing the analysis. Okay. As I said, your focus point would be first to look at the balance sheet of the subsidiary and see what is the position of other equity. So I'll just like to go back to the question and let's see the data. So I guess if I look at the other equity, we are given the retained earnings, and the retained earnings is given to us. It is 750 and it is 424. And we can also have a look at the additional information. It says when H purchased the shares in S, the retained earnings at that time was 5 lakh. And when A acquired the shares, the retained earnings at that time was 175. Now there is no other adjustments except the stock reserve that is downstream in nature. That can be taken later in step number 6. And that's it. I think there is nothing else. So let's organize this input as well. So if I look at the retained earning, let me take my time scale. My date of acquisition is 31st October. My balance sheet date is 31st March. So I think the balance at the end of the year was 7.5 and the balance on the date of acquisition was 5 lakh. So we can easily decide what is pre and what is post. So can I say 5 lakhs becomes pre, and you can say 2.5 lakh becomes post under a separate heading, that is retained earning. So are we done with the analysis in terms of the subsidiary? We're done. So let's take this sum total. This is 5 lakhs and this is 2.5 lakh. Similarly, let's come to the analysis of the associate company as well. So we are given the retained earnings. Let's take a time scale. This is on 30th June and that is 31st March. I guess 30th June was 1.75 lakh. What was 31st March figure? I forgot. I guess 31st March figure was 424.
Yes, sir.
So yes,
424.
that comes to 4.24 lakh. So 1.75 is going to be pre and the balance increase is post under a separate head that is retained earnings.
2,49,000.
Okay, this comes to 249. And this takes care of the analysis of the associate company as well. The pre is 1.75 and the post is 2.4 lakhs. So this is my step number 2A. Everything is going double because of the associate and the subsidiary. It's like, 2 questions in a single one. Let's also organize now the inputs in terms of step number 2B. And in terms of step 2B, we need the net assets on the date of acquisition, and we need the net assets on the date of acquisitions for both the company. So let's organize the input for both the companies. We need subsidiary also, associate also. So this is going to be a sum total of the equity share capital and the other equity, which is pre-acquisition in nature. So let's go to the balance sheet, see what is the equity share capital. So the equity share capital is 2 lakhs and 1 lakh respectively. So the equity share capital is 2 lakhs and this is 1 lakh. And the pre-acquisition equity is 5 lakhs and this is 1.75 lakhs. So this works out at 7 lakh and this works out at 2.75 lakhs. That is the net assets on date of acquisition. So far, so good. Okay, so as of now, what do you say? Is the question looking technical or isn't it easy? Nothing in the analysis by far. What do you say? Easy, isn't that so?
Yes, sir.
Wonderful indeed. So where were you exactly stuck a bit on this particular question?
Sir, actually, that's adjustment you have told in initially.
I got your point. The bonus and the dividend was the scary
Yes.
factor. Okay, let's go to the step number 3. We organize the purchase consideration. And in terms of PC also, let's organize for both the companies. So what is the investment H in S and what is H in A? So let's go back to the balance sheet and see what is the investments appearing in the balance sheet. The shares in HNS is 560 and this is 1 lakh. So 560 and 1 lakh is the PC. So this is, I forgot the figures again. What was the investment account?
Sir, it is 560, 5,60,000
And
1.
1 lakh. Correct. So this was step number 3. Then we go to the step number 4, that is NCI. Do we need an NCI for the associate? No.
No.
So we need the NCI only for the subsidiary company. So for the NCI, we need the NCI on date of acquisition. And as you calculate the NCI, you need to be careful that not only the post-acquisition share, but if NCI is at a fair value, the goodwill impairment will also be hitting this. Though in this case, it is at PASNA, so goodwill impairment adjustment will not impact this. So let's see what is the NCI position given to me. So we are clearly given in terms of the NCI, I think it was mentioned in point number 4, NCI is valued at PASNA. So there is nothing to be taken in terms of NCI. So let's see what was the net assets in step number 2B. That is 7 lakh. So we take the
7
net
lakh in
assets.
2.5 lakh.
into
72.
30%? Correct. So that comes to 2.1 lakh is the NCI on acquisition date based on PASNA. And then to this, we add the share in post-acquisition profits. So let's take the share in post-acquisition profits.
1,75,000.
So post is 1.75 into 30%.
Sir, that 30% is 75,000, sir.
Post
175
acquisition
is
is
holding share. Sir, total post acquisition profit was 2.5 lakhs.
2.5 into 30% we need,
30%.
yes. So
It
this
comes
is
to 75.
2.5. So post acquisition is 2.5 into 30% comes to 75,000. Correct. So we get 285 is the NCI on the balance sheet date. Wow. Then I guess we go to the step number 5 and we're going to add a step number 5A as well, because in terms of associate, I just need to add that investment to be shown in the balance sheet as well. So let's have a look at the step number 5, which is goodwill or capital reserve. And for this, we need to consider both the companies. Again, we need the goodwill as well as capital reserve for both. But you know, the technique is going to be different. When you are going to calculate a goodwill for the purposes of subsidiary, it is PC plus NCI versus net asset. But when you calculate a goodwill for the purpose of associate, it is simply comparing the PC versus share in the net asset, because there is no NCI concept. So for the subsidiary as well as for the associate. So let's see the PC plus the NCI and compare this with the net assets to get the figure of goodwill. And there is goodwill impairment also to be taken. So we'll take care of the impairment as well. So let's first organize the data. So purchase consideration, I guess, is 5.6 lakh. NCI acquisition date is 2.1 lakh. That makes it 7.7 lakh. And what was the net assets?
7 lakh.
That is 7 lakh. So this works out at 7 lakh. So we get a goodwill of 70,000. And I think he's already said that the goodwill is totally impaired, right? He's very clearly said that the goodwill is completely impaired. That is the instructions given. Let me just go back. So it says goodwill in respect of the acquisition is fully impaired. So the goodwill is completely gone. So technically speaking, there is not even a point of calculating goodwill. But then since I need to take this goodwill hit in terms of step number 6, you can't afford to miss it out. Because many people will say that goodwill is gone. Why should I even calculate goodwill? I know we don't have a goodwill, but this figure, of course, is required for step number 6. Then let's go to the associate company. In terms of associate, we compare the PC versus the share in the net assets to identify the goodwill, which is going to be a part of the carrying value of the investment in the balance sheet. So PC is 1 lakh. What was the net assets? 2.75. And out of this, we've got a 40% stake in 2.75. Let's see what is 40%.
1,10,000.
1,10,000. So we are getting a capital reserve to the extent of 10,000. Is this going to appear as a separate line item, or is this going to be a part of the carrying value of the investment? It'll be a part of the carrying value of the investment. Okay, so this is done. Now we need to go to the step number 5, step number 5A. Because since we've got an associate, we need to create a step number 5A. This is an additional step which will get created only when there is an associate company getting the investment as a one-line consolidation. So let's see what is the investment in associate. So what was the cost of the investment? I think it was 1,10,000, right? 1,10,000 or 1 lakh, sorry. Investment was 1 lakh, I guess.
Yes, sir.
Yes, sir, 1 lakh.
Right. Now, what we need to do, as I had given you some very basic inputs, though we'll do this formally in Ind AS 28, but I gave you some basic inputs that what you do in an equity method is the net assets of the associate goes up and down, the investment also goes up and down. But there is another adjustment also. First, let's take care of that. So did the associate company earn a profits in the post period? Yes, it did. So what is the impact of the net assets after the profits are earned? It went up. So what am I supposed to do? Investment debit and the P&L RE credit. So what is the share in post acquisition profits?
99,600.
Is that the share? Can you give me what was the total figure, beta?
Total post profit was 249, 2,49,000. Of that 40%, 99,600 is the share.
I got mixed up in the figures. Can you tell me what was the post figure only?
Only post figure is 2,49,000.
2,49,000 into 40%. Right.
99,600.
99,600, that is the share in post that increases the investment value. But now there is one more adjustments, which of course you're not much aware as of now, but let me just make a walkthrough. Let's see what is pending. Point number 1 is done. Point 2 is pending. Point 3 will be ignored. Why is it ignored? Because as far as an associate is concerned, it's a one-line consolidation. So any receivable, payable which is there, irrelevant for us. Goodwill is done. We'll come back to the point number 2. Rest, this is all ignored. Now, let's look at the inventory. Inventory of A on March 24 includes inventory which is valued at 60, purchased from H on January at a cost plus 20%. Cost plus 20% means 1/5 on cost and 1/6 on sale. Now, we'll discuss this in detail later, because since we're doing the question without, Ind AS 28 much knowledge, let me tell you, since this is supposed to be a downstream transaction, what you are going to do in a double effect, reduce the investment and reduce the RE. The parent company's RE is including the unrealized profits it made from sale H to A, and correspondingly double effect, the investment should go down. So 60,000, 1/6, and we take a share. So in this investment value, we also need to take care of the downstream stock reserve as well. So every time you've got a downstream stock reserve, we'll take that. Unsold goods are 60,000, profit is 1/6, but we need to eliminate only the share in the stock reserve. I think that's 4,000.
Yes, sir.
Let's see what is the value of the investment. 195,600.
Yes, sir.
Yes.
Wonderful indeed. And now we are ready. So this is the additional step in terms of associate. Now we're ready in terms of step number 6. So in terms of step 6, the focus is making the consolidated balance sheet. Other equity is what we need to organize. Now, a couple of things what we need to take care out here. There is any stock reserve that is to be taken, goodwill impairment to be taken, and there is also the impact of post-acquisition profits. So we've got 2 post-acquisition. So let's make somewhat a SOKI. So though we've got only one particular tab, but I think we'll still make a SOKI in this case. Let's take particulars and let's consider the retained earnings. So we're making the statement of changes in equity. Let's take the tab number 2, which is retained earnings. And let's take a column for particulars as well. So first we'll consider the holding company's own retained earning. So let's see what is the holding company's own retained earnings, which is in the balance sheet of the parent.
Sir, it is 9 lakhs.
Correct. That is 9 lakhs. And we can just fit this out here. This is 9 lakhs. Now, when you consider the post-acquisition, there are 2 post-acquisitions to be taken. One is the holding share in subsidiary post, and one is the holding share in the associate post, which you've also incorporated in the investment. So we add the share of holding in subsidiary and the share of holding in associate post acquisition profits. Associate, of course, is 99,600. Can you tell me what was the subsidiary post?
1,75,000.
That's total, right?
Sir, that's share.
Okay. I'll just get the total as well.
Total was 2.5 lakhs of that
Okay,
70.
2,50,000 into 70%, that's 175.
Yes.
Great. So this is one adjustment, taking the share in the post-acquisition profits in this case. Now we also need to take care of the goodwill impairment. I guess the goodwill impairment was Pasna partial goodwill entirely borne by the parent company. And we also need to take care of the stock reserve, which is downstream in nature. So let's take the stock reserve, that is 4,000. And I think that's it. We will get the consolidated RE for the purpose. You know, a step-by-step model makes life very simple indeed. Trust me.
Eleven lakh 600.
Right, that's right. 11,600,000 is the total consolidated other equity. Okay, that's wonderful indeed. Now we will also make the consolidated balance sheet as well. So let's now go to the step number 7. So now we need to be careful as we do the consolidated balance sheet in step number 7, because you need to consolidate the parent and the subsidiary, but associate is just one line, so no aggregation of assets and liability for the associate company. So let's see the consolidated balance sheet. Let's begin with the assets side of the balance sheet. So I'll just pick up the figures back from the balance sheet. So if we start with the asset side, let's just add the PPE 550, 480 makes it how much? 1030. So this is going to be 1030. So this is 10,30,000. So property, plant, equipment is 1030. Will the investments appear in the balance sheet? No, but for the associate, yes.
Yes, shit.
So associate would appear what we have computed, that is 195,600.
195,600.
And you'll also make a disclosure in the inner column that this is including a capital reserve. I think it was 10,000 if I remember.
Yes, sir.
Correct. So this is one input. Let's go back on the balance sheet. So investments is gone. So we're not supposed to reflect the investments, but this is supposed to be the investments, which is S and A. So we'll take these investments. Let's add these investments. Sorry, only S. S has got 4,80,000. So investments is 480. Let's do one thing. Can you just add up the figures also to me? Meantime, add up the inventory for both the companies. Add up the cash equivalents and trade receivable, because I'll have to go back. So if you can just give me the inputs out here. So what is the investments of the subsidiary appearing in the balance sheet? 480.
Yes, sir.
So this is 4,80,000. I think that's it on the non-current assets, I guess. Was there any goodwill which we identified? Fully impaired. Now let's come to the current assets. So what were the current assets? If you can better just add me and give me the figures. Inventory and no stock reserve, no stock reserves to be taken, because stock reserve was for the associate. Just add holding subsidiary.
Sir, 8,67,500.
867,500 is inventory.
Inventory.
Okay, next I think we're given the trade receivables, I guess. And add the cash and cash equivalents as well. Just the holding subsidiary, no associate.
The trade receivable is 11,80,500.
Okay. And we can get the cash and cash equivalents as well. I guess the asset side is taken care.
It is 1,87,000.
Okay, wonderful indeed. Let's just quickly go back to the balance sheet to see that we have not missed anything out. So PP done, investment done, inventory, cash, trade receivable, all done. Great. Then we can just go to the liability side. So we'll need the equity share capital of the parent. RE will be taken from step 6. And then you'll have to give me the figures back again. So in the meantime, you can take the total of this. Let's also take the equity and liabilities. So we take the equity share capital. We take the other equity retained earnings as well. I'll do the total. You can just give me the share capital.
Excuse me, sir.
Anji beta.
Sir, actually, I got confused. Why the investment of subsidiary we have taken in the balance sheet?
But subsidiary of investment in subsidiary is not in a related party. It's outside investment.
Yes, sir.
So aggregation of all assets liability outsiders will take place.
Yes, sir. Yes, sir.
So
Just
asset
like
side,
any other asset.
asset side total is 39,40,600.
Wonderful. Now let's take the equity share capital. What was the equity share capital? Was it 5 lakhs, I guess?
Yes, sir.
And the other equity we can consider, this is 11 lakhs 600.
600, yes.
And we can take the NCI, least we forget. NCI is to the extent of
2,85,000.
285. That's right. So this is on the equity front. Now let's see what is there on the non-current liabilities. I think there is a loan, I guess.
Yes, sir. Term loan.
Yes. So what is the total of the term loan? Holding plus subsidy?
5,50,000.
5,50,000. And then let's see, is there any other non-current liability or just current liabilities, I guess?
Sir, now just current liability it is.
Okay, great. So I think current liabilities, we have got 2 liabilities. One is trades payable.
The
So there
trade
is,
payable is 5,44,500.
okay. Any other liability is there, beta?
No, sir.
That's it. So let's see, is the total of the balance sheet matched? Seems to be some discrepancy, I guess. Last 2 digits, not 3 digits, not matching, I think.
Sir, goodwill of associates.
Asset was capitalized a beta. Goodwill of the subsidy is impaired. I think there is some difference which is coming in, I guess, 960,500 or something. Just see,
Investment or associate company we also need to take.
investment in associates, we have taken 195,600. Let me just, I think, see the question once. Yeah,
The trade payables are 3,95,000 and 3,05,000. It is 7 lakhs, sir.
trade payable is 7 lakh. So this is wrong.
Sorry, trade receivable, sir.
Okay.
I'm sorry.
That's okay. Trades payable is correct, right?
Yes, sir.
Okay. So let's go to the trade receivables in that case. So trade payable was how much? 550? No.
No, sir.
What is the trade payable?
5,44,500.
Trade payable?
544,500.
And what is the trade receivable?
7 lakhs, sir.
7 lakh. Okay, now let's see if the balance sheet is agreed on this I think still, I think last 2 digits, 3 digits, I think now matching, should match. This is coming 29, 80, 100.
So the difference is of that investment amount 4,80,000, sir.
Is it so? Oh my God. Why is that investment disturbing us? The difference is exactly 4,80,000.
Sir, actually, in earlier
Oh,
sums, we
this
have
is, sorry.
Was
This is,
the
I think, the total here.
yes, sir.
yes,
This
sir.
is not investment misprint.
Yes, sir.
Yes, sir. Actually, that's why I have asked it to you.
I was looking at the investment, this is outer column actually. So that's fine. That's perfectly okay. So at least we have done it correct because I thought it's so simple a question. So let's remove this investment. Now the balance sheet is agreed, right? Talent 29, 80, 100, correct?
Yes, sir.
Wonderful indeed. Right. So to me, I think the question was not that tough. I would say it's easy, except that, the examiner was testing your mind in terms of, are we clear with the fundamentals of dividends and bonus issue? Because this was the first time that a bonus issue actually came in the exams. And naturally, when you see it for the first time, it gets a little bit scary at that stage. Okay, but I think even if one would have made, if I would have been, let's say, doing it as a student for the first time, I would have made an extract balance sheet, got my, balance sheet of the subsidy post a bonus issue. Dividend, of course, I would have ignored and I would have started doing the question and automatically you get the figures. But I, actually thought that in this case that it can be ignored by even make an extract balance sheet. But if you still make an extract balance sheet, I think it's still okay, fine. Okay, so this is done. Now we are ready to go to our next agenda of discussions. I am now coming to the next area, that is Ind AS 28. We're now on the area that is Ind AS 28. So we've covered on consolidation 110, 111. Now we are on the third one, that is associate. So let's begin the journey, which
Sir,
is in terms of हाँ जी बेटी.
सर सॉरी सर बट मुझे एक क्वेश्चन पूछना है स्टेप 6 में.
क्या
आप
यार?
एक बार स्टेप 6 निकालेंगे फिर से.
Step number 6.
यस सर.
Okay, just give me a second. This is step number 6.
यस सर. सर अल्टीमेटली हमारा जो कॉस्ट का बैलेंस शीट पे इम्पैक्ट आ रहा है इन्वेस्टमेंट का, वो कॉस्ट माइनस रिजर्व ही आ रहा है ना, क्योंकि
Correct.
हमने उधर से वो कर दिया कम और रिजर्व भी नहीं आ रहा. रिजर्व भी ऑटोमेटिकली उधर भी एडजस्ट हो रहा है. तो जितनी
Correct.
कॉस्ट ऑलरेडी हमने जो सेल किया है उससे कम होके उतना ही इम्पैक्ट आएगा एसोसिएट का, राइट?
Correct. So basically, if you look at the balance sheet, अगर आप देखोगे तो बेटा क्या हो रहा है? इन्वेस्टमेंट नीचे गई, आरई नीचे गया, मैच हो गया. क्योंकि मैंने स्टेप नंबर 5A में इन्वेस्टमेंट यानी एसेट साइड पे इंपैक्ट लिया और इधर मैंने लाइबिलिटी साइड पर इंपैक्ट लिया. तो स्टॉक रिजर्व जब एसोसिएट कंपनी में इट कम्स एन इंपैक्ट, इट इज अगेन डिपेंडेंट ऑन अपस्ट्रीम डाउनस्ट्रीम. बट इफ इट इज डाउनस्ट्रीम, investment goes down, RE goes down. But if it is upstream, then in that particular case, stock goes down, RE goes down.
Okay, sir.
Right? So when it is, because there is another thing, I'll tell you. People are at times confused in terms of the stock reserve treatment for subsidiary associate in terms of upstream, downstream, P&L, balance sheet. Are you also confused on that?
Sir, only balance sheet prospectively, क्योंकि reason
No, but we
because
need to be clear on the P&L perspective also. So technically speaking, we should be very clear that what is the treatment of stock reserve, up, down, subsidiary, associate, P&L, balance sheet, both. I'll maybe, do a chart after finish with 28 tomorrow. I'll make a chart on that where I'll give you what is the treatment of stock reserve for upstream, downstream, holding, subsidiary, P&L, balance sheet, everything put together.
Thank you, sir.
You're welcome. Okay, so let's, I think, take the journey forward. I am now coming to the next standard, that is Ind AS 28. I guess I am carrying some inputs with me, which is on the study material. Yes, I think I need to load the study material to you. Just a second. I've taken some extracts from the standard. This is on the application. Okay, let's do one thing. Let's just add, I've already loaded something out here. So I'm looking at the unit number 7, I guess. No. No, I'm afraid this was not the case. Sorry, just give me a second. Okay, maybe I think I can just work upon this directly. Let's give you some inputs directly before I load. Or maybe I can share you on the screen. That would be better, I guess. I can maybe share it on the screen. Okay, I'm not loaded the Ind AS 28 part, no issue. We'll come to that part. I'll maybe share it on the laptop screen. But first, let me give you a little briefing on Ind AS 28. Now, as far as Ind AS 28 is concerned, it talks about both investments in associate as well as a joint venture. Now, first of all, let me make one thing very clear. I want to take you to a particular inputs. Let me share that on the screen to you. Just give me a second. I'll just share something on the screen. I'm sharing the study material because I've not loaded that on the board. So I'm just going to share it to you on the screen out here. Let me know, friends, if you can see the screen, right? Visible?
Yes, sir, visible.
Great. So this is the unit number 6 of the study material, and which is talking about Ind AS 28, investments in associates and joint venture. As we've already seen in Ind AS 111, that as far as joint ventures are concerned, they are also accounted under this standard. Now, I just want to take you out here. I just want to read something what is given in terms of significant influence. Now, this is very crucial. Just watch this carefully. It says an associate is an entity over which investor has got a significant influence. Hence, we need to assess, how do we assess that there is a significant influence? Now, the standard defines that significant influence means the power to participate in the financials and operating policy decisions of the company. So it very clearly says, it does not give you any kind of a percentage per se, but it says that there is a power to participate in the financial and operating policy decisions of the investee, but is not a control or a joint control of these policy. Now let's read this, then I'll give you some insight. Now there is a presumption which is given in the standard, which is quite a rule-based presumption. It says if an entity holds directly or indirectly through a subsidiary, mind the words, I'll take examples on that. It says if an entity holds directly or indirectly through a subsidiary 20% or more of the voting rights, then it is presumed that the entity has got a significant influence, unless it can be demonstrated that this is not the case. The standard says there is an implied presumption that if you've got 20% or more than 20% voting rights in an investee company, you should presume a significant influence unless it can be proven otherwise. Then he says, conversely, if the entity holds directly, indirectly through a subsidiary less than 20% voting power, it is presumed that the entity does not have a significant influence unless such an influence can be clearly demonstrated. Now, what are the factors which will prove me otherwise is something which we'll see later. But the standard per se right now is telling me that if you've got 20 or more than 20, assume significant influence. If it is below 20, assume there is no significant influence unless you can prove it to the contrary. Now, I just want to work a little more on this. Let me just come back to my board. So I am looking at investment. I am looking at investment in associate and joint venture. I want to first of all give you a good level of clarity on two different levels. Let's first begin with the basics. I want to first of all understand that what are the various situations when this Ind AS would trigger. Because I think one of the most important elements is to understand that the situations in this, the Ind AS will assess. Now, let me tell you, how am I going to go about this standard? I will basically cover this standard, you can say, in certain block systems again. My first block system would be to understand what are the parameters when this Ind AS will trigger. And second is, once you say, yes, you are under the purview of this standard, what is the accounting? Rather, in the first one, we'll also look at the assessment part as well. So we'll look at, when do you come under the purview of this standard, including the assessment of significant influence. Second block would be that once a significant influence is established, how does the equity method of consolidation works? And then we're going to do a third, a special issue in the standard, which is a part of the appendix to the standard, which talks about other long-term interest which the investor may have in the associate, which is a very specific, special issue which is addressed in the appendix, covered in detail in the study material as well. So I'm going to divide my discussions in three blocks. Why I create these blocks? Because it creates a lot of image at the back of the mind in terms of how you approach the standard. So I'm going to divide my entire discussion on the standard in three different blocks. The block number one, wherein we are basically going to see the scope of the standard, and we're also going to look at the assessment of significant influence. We're also going to look at the assessment of significant influence. When do you say that you are under the purview of the standard, and how do you assess a significant influence? The second block, what we are going to look at is the accounting treatment. So we're going to look at what is the accounting treatment, that is the application of what we call equity method of accounting. How does the investment appear in the consolidated financials, though we've got some feel already. And finally, we're going to look at a block number 3, which is a special issue, which is supposed to be a special issue. And this special issue is with reference to other long-term interest. This is with reference to other long-term interest which the investor could have in terms of associate. So we'll see what is the other long-term interest. Right. So I guess I have given you the inputs that this is the 3 blocks. So what we're going to work today is on the scope of the standard. Then we'll look at the other factors later. Let's begin a journey in terms of the scope. Now, moving further, to give you a little basic insight further. As we read in the study material, that significant influence means that investor is got directly or indirectly through a subsidiary. Now, what's this? I'm taking some permutations combination. There is a company A, and this company A is, let's say, got in terms of B. Let's say company A has got in terms of company B, let's say 20% or more voting power. If I say that this company has got 20% or more than 20% voting power, I would say B is an associate of A. It's a direct percentage. It's directly held. So in this particular case, I would say this is a case which is directly held. This is a case which we can say is directly held. A is got a 20% or more than 20% voting power in terms of B. Next. Let's look at a situation where there is A and there is B and there is C. Now, in this particular case, let's consider A and B and B and C. Let's say A has got 60% in B and B has got, let's say, 20% or more. Let's say it's got 20% or more voting power in terms of C. Now, in this case, you can see that A is got in C indirectly through a subsidiary. Here we can see that we're looking at it is indirectly. It is indirectly, and this is indirectly, you can say, through a subsidiary. This is indirectly through a subsidiary. That's the key point. That what is important is that you're holding through a subsidiary, you can say a certain stake. Now, in this particular case, if you say that A has got a 60% in B and 20% in C, you might say that A has got a 12%, 60% of 20, a 12% in C. For the purpose of deciding whether C is an associate of A, I'll not look at any percentages. I'll just look at this percentage 20. I'll not take 60 into 20. I'll see only 20. Yes. If I want to see that what A has got a share in the net assets of C, I'll say 12%. So there are two things. When you're making the assessment of the significant influence, you're looking at a percentage which is going to be directly 20. There is no need of looking at 60 into 20. For the purpose of deciding a significant influence is present, you can say that yes, there is a 20% significant influence is there. But when you say that A has got what share in the net assets of C, then it is 12%. So this was the clarification given that it is directly held or it is indirectly held. Let's take another situation as well. Let's say there is a company A, let's say there is a company B, and let's say there is a company C. Now let's say A has got a stake in B and B has got a stake in C. So let's say A has got in B 30% and B has got in C 30%. Now in this particular case, can I say that C is an associate of A? No. Because it is indirectly held through an associate. And what is important is that it is indirectly held through a subsidiary. So in this case, we can say it is held through associate. It is held through an associate company. So when you say it is held through an associate company, C is not an associate of A. C is not an associate of A in this particular case. And in this case, we can say, yes, C is an associate. We can say C is an associate of A in this case. And of course, B in this case is also an associate of A. So it is B is associate of A. I hope you got the picture very clear in terms of what is direct and indirect, because many people tend to get confused on the area that it is directly, indirectly. What is important in an indirect is through a subsidiary. So either you hold a direct percentage, or if you hold an indirect percentage, it should be through a subsidiary and not through an associate. I hope you got the point very clear. Wonderful indeed. Let's take it further. Now, having said that, we are now putting a thumb rule and then we'll take it further. So the thumb rule, what the standard has given us is that there is a presumption. The thumb rule which is given in the standard is that there is a presumption, and the presumption is if an investor has directly, circle the word directly, or it is indirectly through subsidiary. It is indirectly through subsidiary. Circle the word indirectly through subsidiary. So that'll give a focus point. That if the investor has directly or indirectly through subsidiary 20% or more voting power, there is a significant influence. There is a significant influence. But this presumption can be challenged. This presumption can be challenged. How it will be challenged, that we'll see later. So we'll work upon how it can be challenged. But I think one thing which we are saying, that the thumb rule is, if you get 20% or more than 20% directly, indirectly through subsidiary, you are presumed to get a significant influence, otherwise not. But this can definitely get challenged as well. So now I need to work upon some inputs with you. Now what I'm going to do, friends, for the next half an hour with you is going to be a bit technical indeed, and which of course in the next class I'll have to perhaps consolidate again. Are you ready for a little technical discussions for the next 20-25 minutes? Say yes.
Yes, sir.
Great. So I don't want to get into the concepts of how do we challenge the significant influence. That part we'll discuss later. But I want to first of all take you to some very interesting inputs, just like we saw in terms of Ind AS 110. We've got some very interesting paras in the standard. So I'll share the para number 17, para number 18 and 19, which we are going to work upon. Now this is going to be slightly technical, but you'll love the discussion. So I'm looking at the para number 16, 17, and we're looking at the para number 18 and 19. And we'll do case studies on that as well. So let me just come back and have a look on this. So we are now looking at the fact. That you are saying associate relationship is established. But then still, in spite of the associate relationship, are there any exceptions or are there any exemptions, in which case the consolidation under 28 will not trigger? That's what we're looking at. Let's read the application of the equity method. An entity with a joint control or a significant influence. Now, one thing more I would like to clarify at this stage, because there could be one confusion and I want to first, make it very clear. Now, let me just come back on the agenda. I gave you the chart in terms of, this clarification. I just want to make one thing more clear. Let me also do a small little exercise further before I proceed. Let me just come back on the agenda. I'm now giving you situations where Ind AS 28 would apply. Now watch this carefully. You need to vouch me. I'm going to blend 111 as well as 28 to have a look at the picture. Decide this carefully. There is a company A, there is a company B. And I say that company A has got in terms of B a joint control. Mind the words carefully. Let's say A is got in terms of B joint control and it is classified as a JV. And it is classified as a JV, a joint venture. Would B be an associate? Yes or no? It's not a case of significant influence. It is joint control resulting in a joint venture. Would Ind AS 28 apply to A for B? I know there's going to be confusion. Yes, what did you say, beta?
Sir, that 28 is for both joint venture and associate.
Correct. So it will apply. So can I say if it is a joint control but resulted in a JV, we can say that B is, rather I would simply say that we need to apply Ind AS 28. Ind AS 28 will apply in this particular case. That is one. Let's give you more case so that we get clarity. Let's give you another case as well. Now I am looking at A and B, and I'm looking at A is got in B joint control. And this joint control resulted in that it got classified as JO. Is Ind AS 28 going to apply? A is got a joint control, but it's a JO. Can I say I'll apply Ind AS 111? Am I right? Not Ind AS
Yes.
28. Great. Let's see another situation as well. Number 3. Now this is going to be interesting. Let's say there is A and let's say there is B, and let's say A is got in B. A is got in B. Can I say A is party to joint arrangement, is a party to a joint arrangement. Mind the words carefully. A is a party to a joint arrangement but has no joint control. He's a party to the joint arrangement, but he's got no joint control. Would Ind AS 28 apply in this case? Can I say A is got no joint control? I'll make an assessment of significant influence in this case. Correct?
Sir.
Wonderful indeed. So I will say in this particular case, he's got no joint control. So we will assess significant influence. And if the answer comes a yes, we will apply Ind AS 28. So this is another case. These are little offshoots. That this is joint control JV, this is joint control JO, this is no joint control. So you assess a significant influence. And if it is no, then which Ind AS would you apply?
109.
That's right. We will apply Ind AS 109 in this particular case. So we will apply Ind AS 109. Let's look at another fourth situation as well, which is simple and straight. Let's say A and let's say B, and let's say A is got in B significant influence directly. It has got a significant influence itself. You can see here I took joint control. Here I said no joint control. So you made an assessment of a significant influence. Here we're saying it's got a significant influence. Can I say we will definitely apply Ind AS 28? So these are few permutation combinations which I wanted to give you as a clarification that when Ind AS 28 is supposed to be applicable, what goes at the back of the mind is that we've got a joint control with a JV 28. We've got a significant influence 28. We've got a person who is a party to the JA, but he's not got a joint control. If he gets a significant influence, he comes under the purview of this standard. But if it is a joint control with a JO, then it is Ind AS 111. Now we can come back with this clarifications. I am coming back to the agenda. Let's come back to the para number 16 onwards. Okay, now I'm going to read the few inputs, then we'll make some image in the mind. Don't worry, notes will be taken later. Let's begin. It says an entity with a joint control or a significant influence over the investee shall account for the investment in associate or a JV using equity method except when that investment qualifies for exemption in accordance with para number 17 and 19. The standard says that if you've got an investment in associate or a JV, you are supposed to apply an equity method of accounting. But there are certain cases where there will be an exemption. Let's read the para number 17. It says in terms of exemption, an entity need not apply. When I say need not apply, is it mandatory or is it supposed to be an option in life? It says that there is entity need not apply. You saw the same language in terms of Ind AS 110 as well. Can I say this is optional in nature? It is my choice that even if I fulfill the conditions, I can still apply or I may not apply. An entity need not apply the equity method to investment in an associate or JV if the entity is a parent that is exempt from preparing consolidated financials by the scope exception in para number 4A of Ind AS 110. Oh my God. Do you remember the case of para number 4A of Ind AS 110 where we saw the 4 cases where we said the 4 conditions are there? One is that it is a wholly owned subsidiary or a partly owned subsidiary and you get an NOC from the outsider. It's not a listed company. It is not in the process of getting listed. The ultimate parent or the intermediate parent is preparing a console for public use as per Ind AS. So he's reminding me the same inputs out here that he says an entity will not apply the equity method in an investment in associate if this entity is a parent. So what is he trying to tell me? That let's say there is a company A which has got a subsidiary company B and it has got an associate or a joint venture C. Mind the words carefully. It says there is a company A which has got a subsidiary B and it has also got an associate or a JV that is C. Now, by virtue of Ind AS 110B, A is given a choice not to consolidate B. So give him a choice under Ind AS 28 as well. Because he's already got a choice under 110, let's give him a choice under Ind AS 28 as well. Tell him that, boss, you don't need to consolidate your subsidiary, you don't need to consolidate your associate and joint ventures as well. So moral of the story, if the investor is supposed to be a parent of another company and he's getting exemptions under the 4 conditions of 110, that is para number 4A, he should also automatically get an exemption under Ind AS 28 for associates and JVs as well. I hope I'm clear. I know what I'm speaking is technical. I said, the next few minutes, couple of minutes, 10, 15 minutes is going to be crucial. Did you get my point?
Yes,
Let's
sir.
take further. Great. Then he says, or if all the following apply. So either you prove it this to me or if all the apply. Now, what is all the following that applies? It says the entity is a wholly owned subsidiary or is a partly owned subsidiary of another entity and its other owners. This condition, debt equity instruments not listed, not in the process of listing, ultimate intermediate. Trust me, these are the same 4 conditions what you have done in Ind AS 110. So prove that entity is a wholly owned subsidiary in this particular case. So what I am now looking at is the fact. I think the crux of the matter. Let's put it like this. The para number 17, more or less, I'll take it like this. A company is able to avail the 4 conditions of 4A. So this is something like, a middle company, because there would be somebody sitting on the top as well. He will be able to meet the 4 conditions once he is in the chain. He will be able to meet these 4 conditions once he is in the chain. If he meets the 4 conditions of 110, automatically he gets an exemption under 28 as well. So A will neither consolidate B or C. He gets a choice, but X will definitely consolidate B and he will also consolidate C. Now let's go further. This is another 2 very interesting inputs given. Let's look at the para number 18, what it says. When an investment in an associate or a JV is held by or is held indirectly through an entity that is a venture capital, a mutual fund, a unit trust, and similar entities. It did not say through subsidiary. It did not say through a subsidiary. See the words carefully. It says when investment in an associate or a JV is held by or is indirectly held through. There are 2 cases. Let's say there is a company A, there is a company B. Let's say there is a company A, there is a company B, and there is a company C. Now let's visualize the inputs out here. When investment in an associate or JV is held by, let's look at held by. When the investment in associate or JV is held by an entity that is a venture capital, mutual fund, trust, etc., the entity may elect to measure that investment at FPTPL in accordance with Ind AS 109. Entity shall make this election separately for each associate JV at initial recognition itself. Now please hear me carefully. If A is a venture capital organization or a mutual fund, it very clearly says that if A is a venture capitalist, he is a mutual fund or a unit trust. Now let's ask ourselves one fundamental question. If I'm a venture capitalist, I am definitely going to put in money into various companies because I am the venture capital finance. I'm financing those companies. I'm a venture capitalist. So for me, attaining a significant influence is something which is, by default of being a financer. And as a venture capitalist, if I've got 5 different projects and these 5 different companies, I've got a significant influence in those particular cases, I will get a significant influence. Now you tell me to apply an equity method, I might go crazy. Because what happens in a venture capitalist is that you get the idea from a particular person and you say that, okay, I'm going to pump in money, you get a 51% stake, I get a 49% stake. That's how generally the venture capitalist will do in a practical world. That it's the concept where you tell the person who's got the brilliant idea that you are going to put your idea into place, I'll pump in the money, and you take a 51% stake in your idea, I take a 49%. So with the 49%, I will generally get a significant influence over B. So being a venture capitalist, you get a significant influence over B, and that is, by the way of providing finance. So the standard setters thought that let's give them a choice. Let's not tell them that you cannot consolidate. You've got a choice. You can tell A in this particular case, either you use equity method under 28 or you apply the concept of fair value through P&L, Ind AS 109. It's your choice. It's your choice. So they said that when investment in an associate or JV is held by an entity which is a venture capitalist, mutual fund, or unit trust, it may elect to measure that investment at FPTPL. And this election will be accounted separately for each associate or joint venture. So if I've got, let's say, 5 different associates and JV, I will decide that for 2 of them, I want to apply FPTPL. For the rest of the 3, I want to apply an equity method. I can do that at the initial recognition itself. So this can be done at the initial recognition stage. You can pick and choose. Within this para number 18, there is another inputs also coming in. And what is that input? Now it says it is held by indirectly through. Now in this example, it is B. It is B. It says that it is indirectly through an entity that is a VC. So which means B is the VC or the unit trust or the mutual fund, and he's got a significant influence. So what does A need to have over B? Control. Because in the initial standard itself, they said that you need to have a directly or indirectly through a subsidiary. So if A has got a subsidiary, which is a mutual fund, a venture capital, a unit trust, and these invested in C with a significant influence, I will give A the choice that you need not consolidate C. You can directly reflect investment A in C, FPTPL, or you can choose an equity method. So moral of the story, the para number 18 is telling me that if I am the VC, venture capitalist, I may elect 28, I may elect 109. If I am not a VC, but my subsidiary is the VC, if my subsidiary is the VC, then I again get a choice that I can consider associate as per 28 or FPTPL. So this is more like directly and this is more like indirectly. Don't worry, the notes will be made later. Now let's come on to the para number 19 as well in this particular case. So we've seen the para number 17 is a matter of option. The para number 18 is a matter of option. And we'll also see when the para number 18, which is optional, can become mandatory in life as well. You heard me correct. There are cases when the para number 18 is going to become mandatory because of the application of Ind AS 110. That we will talk later, not right now. Let's go back now to para number 19. When an entity has an investment in an associate, did you notice something? If not, I'll make you notice. If you go back to the para number 17, it says associate or JV. If you look at the para number 18, it talks about associate or JV. But if you look at point para number 19, it says associate. The word JV is nowhere written. The word JV is nowhere written. The para number 19 is going to be applicable to an associate company, not applicable to an associate, a JV. It says when an entity has got investment in an associate, a portion of which is held indirectly. It's a portion held indirectly. So A in B and B in C. A is got direct and A also has got indirect. A has got a portion which is direct in C. A has got a portion which is indirect in C. So he has got investments direct plus indirect. What is para number 18? The para number 18 is either direct or indirect. Mind the words carefully. The para number 18 is either direct or indirect. The para number 19 is a direct plus indirect combo for associate. It says a portion of which is indirectly held through a venture capital organization or a mutual fund, unit trust and similar entity. The entity may elect to measure that portion of the investment in associate at fair value through P&L in accordance with Ind AS 109. Now what does it say? B is supposed to be the venture capitalist mutual fund. So for the portion A in C direct, Ind AS 28. For the portion A in C indirect, FPTPL or Ind AS 28, my choice. Get this clear. So there are two portions of the investment. One is direct and one is indirect. So for the direct portion, you are going to consider Ind AS 28. For the indirect portion, you get a choice, Ind AS 28 or in FPTPL, your choice. Let's read. And it says, regardless of whether the venture capitalist has got a significant influence over that portion, so it does not make a difference. Now there is another clarification coming in, and there was one very interesting question which was there in the study material as well, and which tells you, came in the RTPs, I guess, where this para number was very well tested. Now, if you say that this is, let's say 20 and this is also 20, this of course is control. A is got independent significant influence over D. A and B is got in C independent significant influence. A in C is significant individually. B in C is significant influence independently. But let's say if this is 20 and this is 10. Or let's say if this is 10 and this is 10. It doesn't make a difference to me. The application of this para number 19 will not get impacted. So whether you can say A in C plus B in C, individually SI, one SI, other is not SI independently, or both are not, but together it is. Because 20 plus 20, 40. 20 plus 10, 30. 10 plus 10, 20. Clubbed together, there is a significant influence. Even individually, there is no significant influence. It doesn't make a difference to me. See what it says. It says, regardless of whether the venture capital has got significant influence over that portion of the investee, if the entity makes that election, it shall apply the equity method to any remaining portion of the investment which is not held through a VCO. So this is getting too technical indeed. Can you please club this information and tell us something? I'll now make your life simple. We'll do the documentations later, but I just want to get the crux of para number 18 and the crux of para number 19 and the crux of para number 17 in one go, first of all. I would like to put it like this, that technically speaking, if you ask me, I would say there are basically three situations coming in. I would say there are basically three situations which are coming in. This is the crux of the matter. The notes all we'll do later. Don't worry, we will work through this inputs again in the next class as well, because I know this must be very technically hard. So no worry, we'll make this walkthroughs and we'll get some case studies going on this area as well. I'm looking at three situations. Watch this carefully. The first one I'm looking at is para number 17. The other one I'm looking at is para number 18. And the third one I'm looking at is para number 19. Let's, I think, first of all, focus on each one of the situations and see what is the insights given. Now, let's consider the case of para number 17. Now, what is the case of para number 17? There is a company A, there is a company B, there is a company C, and there is a company D. So we've got a control, and we've got a significant influence, or we've got a joint control resulting in a JV. Mind the words, mind the chain of thought. Now, in this particular case, what is the focus in terms of the para number 17? B, with reference to C, is applying Ind AS 110. B, with reference to C, is applying the Ind AS 110, para 4A, 4 conditions. He looks at the para number 4A, and he looks at the para 4A, 4 conditions, and they are met. So B is able to meet the 4 conditions of the para number 4A. So we give him a choice. We tell him that you don't need to consolidate C. Give him a choice under Ind AS 28 for D as well. Simple. So in this case, he is getting a choice not to consolidate for C. Given this choice under Ind AS 28 also automatic, auto. So since he qualifies the conditions of Ind AS 110 not to consolidate, give him also, boss, your choice. You may not. Next. I'm now looking at para number 18, where we're looking at A and B, and I'm looking at A in B and B in C. This is significant influence, and this is joint control resulting in a JV. This is control, and this is supposed to be significant influence, or it is joint control resulting in a JV. Now, in this particular case, what we are saying in this case is that as far as A is concerned, he is a venture capitalist mutual fund unit trust. He's a venture capitalist mutual fund unit trust. We say, your choice, don't follow consolidation of B equity method. You want to consider FPTPL, you do that. You want to go for equity method, you do that, your choice. And in this case, it is B, which is supposed to be the venture capitalist or the mutual fund or the unit trust. And we again give the same choice to A. So in this case, A himself meets, and in this case, the subsidiary of A meets the condition, we give him a choice. This is like a direct one, and this is like an indirect one. Now let's see what is given in terms of para number 19. In terms of para number 19, we're looking at A in B and B in C. So we're saying A also has in C. This is direct, and this is, let's say, significant influence, no joint control. I'm not writing joint control, and this is control. So this is supposed to be indirect in nature. So we are telling A in this particular case, we're telling A, and B is now the venture capitalist mutual fund, etc. So we're telling A, for this portion, please go for equity, and for this portion, go for equity or FPTPL, your choice. We told him that for the direct portion, you need to go for equity method only. For the indirect portion, you get a choice. And the clarification which comes in is that this choice is going to be available. This choice is going to be available irrespective whether this is independently SI, this is independently SI or not. But what is important is put together, it should be SI. Put together, there should be significant influence. Individually, it is there or not, doesn't make a difference. I hope, friends, you got the basic thought processes clear. I hope you got the basic thoughts clear in terms of 17, 18, 19. I know we need to work a little more on that, which I will do with a lot of practical examples also in the next class. I think this must have been quite tiring indeed. You know, out of the entire class today, I think the last half an hour would have been quite heavy indeed. But it's okay. If you've understood, then it's pretty good enough. Okay, right, friends. I think that seems to be almost the end, I guess. I don't want to stretch it too beyond as well to make your minds go wild. So let's see if there is any questions which are coming to your mind as of now.
So it's not from this current topic, but it is from the consolidation. While solving questions, we start with steps and calculation, and at the end we prepare a balance sheet. So this approach would be also appropriate for exam, that showing balance sheet at the end, not in the starting of the answer.
Yeah, should not be a problem. But otherwise, you know, what you can do is you can, you know, because many people ask that question that can I show indirectly the step which is like a working notes earlier. I don't see that there is any problem. But if you're still a bit apprehensive, what you can do is leave some space at the beginning for the balance sheet, step 7, carry on the step 6 as a working notes, then you can come back to the balance sheet. But otherwise, I don't see that there is much challenge, because indirectly, if you see, my 6 steps are the working notes, 6 working notes, and the 7th one is the main solution. So in any case, if you're a bit apprehensive, leave a space at the beginning, for the balance sheet, start with the step 1 to 6. That's a good idea.
Okay, sir.
Yeah. Right, I guess that seems to be good for the day. Right, friends, so I think on that note, I think I take your leave for the day. I'm going to see you in the next class, continue with the remaining portion, consolidation. Thursday, we're going to finish with consolidation, because Saturday we've got a fresh topic in terms of the framework, which would of course be my last session with you for this particular batch. Right, friends, so I think it's time to bid you goodbye on that. Enjoy your day. Thank you. Bye-bye and take care.
Thank you, sir.
Thank you very much.
Thank you, sir.
Anji, thank you.
Thank
Thank you. Same to you. Thank you.